That's you.
All right. Good morning. I see we have several people on already. Hope everybody's doing well this morning. I think you have a little chat button on the upper right of your screen. We'll be using that today. So if you want to respond and say who all's on, that'll be great. We'll give a chance. I think we've got 5 or 6 on right now. We'll give a chance for several more to log in before we get started. Good morning. We've had some more people join, I believe. If you want to chat in, good morning, Vince, Hunter, Chad. Appreciate you all being on 7:30 Central Time. It's 8:30. I'm Eastern Time. I'm in Tennessee. So glad you all are with us. So I don't know if Malcolm's on yet or not. If you are, good morning, Malcolm. If anybody else has joined, if you'll just use your top chat button and let us know you're here. Gareth, hello. We would appreciate that. Hunter on the X Dome, yes. Yes.
Hey, Bob.
Yes. Yes.
I'm on it, but I don't know if that little check mark where you put it, added that number there. Okay.
Yeah, there's a top chat button up there on the right. Do you see the screen?
I got you on the screen, and then there's this. I don't see that part.
Okay, hold on just a second. Davey, can you help?
Oh, I see it.
Okay.
I had to minimize it.
Okay, all right, good deal. Thanks. Malcolm had called in. We appreciate it. I think he's live now. Malcolm, if you want to hit the top chat and just confirm you're on, we'll go ahead and get started here in just a second. Had some more autos come in. Thank you. Oh, Vince is asking, do we have any materials ready? Yes. If you came through the website, there's a little link where you came in for the materials. I'm not sure if Malcolm sent those to you, but you can go to the website. It's robertlweb.com. You can download all the materials there. I think there's a link up there now. Okay, Malcolm's on. Good, thank you. Does anybody else need materials? They're all there on the website, and there's a link to them. There's 3 sets of materials. We'll start with the PDF first. And while we may have a couple more people to come on, we'll just go through just a couple of general things. First of all, thank you all for being on. I appreciate it. Thank you, Malcolm, for inviting me. A little bit different doing this remotely, virtually rather than in person. I'm used to the in-person Vistage meetings, but we'll be glad to do this virtually today. Okay, Vince, you don't have to open those. Vince, thank you for the question. You don't have to open those. We'll be opening those and they'll be on the screen. I'll be doing a screen share and you'll see those in just a minute. But they're there for your use later on if you like that. But again, thank you for participating. Thank you for being on. I think most of you have seen the little top button, top chat on the upper right. I want to make this as interactive as possible, so be sure to send those in. I can see those live. Just know there's about a 15 to 20-second delay from the time you send it in till I see it. But I normally ask for lots of questions during these presentations, so it's interactive and good for your use, because my main goal is for you to have takeaways today. And so having the questions and being able to answer those, I think are some of the most valuable parts of this. So be sure and do that. If you accidentally hit pause, or you hit pause on purpose even, and you need to come back, there's a live button, I think right next to the volume control. You can hit that and you'll immediately come back to the live presentation. This will also be on the website after we finish, probably through the weekend. And you can download it if you want to. You can watch it again if there are certain segments you want to participate in. You can do that as well. So it's not available to the general public. It's part of the price that you're paying to be a Vistage member, so it's for your private use, but you can use it at your discretion. We'll also take some breaks today. Probably about every hour, we'll take a 10-minute break. If you're like me, you've had so many Zoom meetings and they get tedious, so we want to make this as easy as possible for you to learn today and have some good takeaways. So we'll take a break about every hour for about 10 minutes. And Malcolm's, since it's your group and you know them obviously much better than I do, you can chat in and say, hey, speed this up, or let's go back to this topic, or whatever's good for the group. Feel free to chime in. I always invite the chairs to be a participant as well. So I want to guide this presentation for everyone's benefit. So if there's things that I need to do different or enhance as we go along, just make those known to me, and I'll be glad to do that. All right, it looks like we've got about everybody. It looks like we have about 10 or 12 on. So we'll go ahead and get started. Now we've got a few little housekeeping things out of the way. But my name is Bob Webb, and Malcolm's invited me today. I speak to 6 or 8 Vistage groups per year. So I'm not a professional Vistage speaker, but I own 2 businesses, like many of you are owners, presidents, CEOs of companies. I'm in the same boat that you're in. So I have a business, I have employees, I have some of the same concerns that you do every day. So I'm a practitioner. What we do is we work with companies that simply want to improve. So we help them. Today's presentation is about key metrics. We're data believers. We believe that if you have good data, you can make good decisions. So we're going to talk about some of those topics today and how to make better decisions with good data, and what are some of the key data metrics that you need to use. But I work primarily with family businesses, normally in the $20 to $50 million revenue range. Sometimes we work with smaller firms. Sometimes we work with larger firms. I know some of you all are in the construction business. Some of you are in manufacturing. I spent about 20 years in manufacturing myself, and we've had many manufacturing and construction, wholesale, distribution, professional service clients. So we understand a lot of your business models. We learn from every engagement. We learn from every Vistage presentation. So it's a learning experience for us, because we're constantly trying to improve ourselves and our business. So that's what we want to do today. Is we want to help you improve. We want you to have some firm takeaways that you can go back to your business tomorrow and implement some of these things to help you grow and make your business more profitable for you and your families and your employees. So again, interactive, we want to see questions continually through the presentation. If you think of things during the break, if it's a more extensive question, you can send those in during the break. Even after the presentation, you can email us. We'll be glad to answer those. I have one of my other team members here with me today to help with that. And another thing that I offer all my Vistage clients is a free half day of consulting. So no fee at all. We'll be glad to talk with you, spend up to a half a day at no fee at all, just as sort of a give back to Vistage, because we enjoy working with the Vistage group. So I work with them all over the country, our practices all over the country. So we get to know a lot of people that way, and we appreciate your questions and are glad to have a little bit of a give back. So if you have any questions right now before we really start diving in, go ahead and send those in. I'm going to take me just a couple seconds here. I'm going to do a screen share. I'm going to pull up the PDF. We're going to start through that, but we'll be happy to take questions as well. So let me pause here just for a second and grab the screen. If I can do that. Maybe I can't. Here we go. There's our presentation. Let's go full screen here for just a second. Top business metrics. All right, so these are going to be the business metrics from Survive to Thrive. Pause just a second. I appreciate your patience here for this. So now here we go. Like I said earlier, I think everybody's tired of Zoom meetings, so we're trying this on YouTube, see if we can make this work and maybe be a little bit better format. But these are the metrics that we think every business leader needs to be focused on. So, all right. Normally when we go to companies, just like yours, and we work with them and they say, how can we improve? What are the things we need to do? We look at three major areas. We do an assessment on what we call the three pillars: financial, operational, and organizational. So from a financial perspective, we look at where are we currently and what's our plan to improve. That's really what our finances are telling us. Our balance sheet, our income statement, cash flow statement. Those are the things that we look at monthly. Many of you have dashboards. We help create dashboards for companies so we can monitor other metrics that we'll talk about daily and weekly. But all those tell us where we're at and what are we planning to improve. What's our goal? How close are we getting to our goals? Operational, the operations, the heart of the business. Where are the problems and where are the opportunities? What are the things that are we doing good that we can do better? What are the things that we're not doing good? Where are the areas we need to improve? What are our bottlenecks for our service or our products? What are the things that we need to look at and how do we improve those? Often companies are held up by one or two bottlenecks that when those are freed up, they're able to work more efficiently, more profitable, serve their customers better. So we look at the operation and then we look at the organization. Probably the single most important is the organization. Do we have the right players? Are they in the right seats? Are they doing the right things? Are we all going in the same direction? So we look at the organization very carefully, and we try to put the right people in the right places, and that's very critical, as I'm sure you know. We'll do a little exercise on that later, where we'll talk about how do we measure our team members, how do we motivate them. We'll go through a little exercise after one of the breaks that will highlight some of those areas. All right. So one of our little phrases that we like to use, one of our little taglines is management by data on the financial side. So order to cash cycle, that might be a new concept for you. We're going to talk about that. From the time we receive an order from a customer till the cash is in the bank, how long does that take? Many times it's over 100 days. We've seen it be 120, 125 days. Now, this is not the same as your AR aging, your accounts receivable aging, which measures the time from invoice to collection. This is your entire cycle of the service you deliver, whether you're a manufacturer, whether you're a contractor, whether you're a professional service provider. What is your order to cash cycle from the time you receive the order to the time you collect the cash? This is one of the things, and if you're making some notes, if you printed out the presentation, or if you just have a notepad, or you're using your iPad or phone, this is a good place to make a note that you can go back to your business tomorrow and start determining what is your order to cash cycle. What I encourage companies to do is to simply sit down from orders that they've recently been paid for, pick that order. You need to do several. If you have different product lines or different service lines, I'd pick one or two from each one. So we got paid yesterday. Now let's trace back all the steps. When did that order start? When did we first receive an email confirmation or a signed purchase order, or whatever, maybe it's been a verbal agreement from a customer? When did that start, and when do we get paid? How many days did it take? You'll be surprised. It may often exceed 90, 100, 110 days. Then we ask companies to go back, and sometimes we do this for clients, sometimes they do it themselves. What were all the steps that were necessary in order to complete that order and get paid for it? Was there a pre-sales effort? Was there pre-engineering? Was there a formal estimate and quote? Did we have to go back and adjust the quote after the customer agreed because they made changes? What's our main production cycle, our main service delivery cycle? When did we invoice it? Were there returns involved? Were there corrections? All these kinds of components that go into it, and try to get an overall idea of what the steps are, how long it takes, and then we can start analyzing to say, how can I compress that cycle? If you can take 10 or 15 days off that total cycle, now you're able to deliver more product or service in a year. You're able to collect your money faster. You're able to reinvest in the business. Order to cash cycle is not something that most people walk around with that number in their head. It's not something they calculate, but yet it's critical to the business. We'll go through an example of it in a few minutes. Accounts receivable, you're really financing your customers, and often that's necessary. Most companies have accounts receivable. We're not going to spend a great deal of time on accounts receivable, but we will touch on it. I've got a handout that addresses it. But that's how you finance your customers to achieve more business. Accounts payable is the reverse of that. Your vendor is financing you. So what we try to do with companies is to look, what's our accounts receivable days outstanding? What's our accounts payable days outstanding? And are those two in balance? That's what we really want to achieve. The absolute number is not as critical as the balance between those numbers. So if we're paying faster than we're collecting, that's an issue. It can be an issue if we're collecting faster than we're paying. We want to have them in balance. I've seen many companies that were in trouble that sort of beat their customers to death, and they were able to collect fast, but then they paid slow. And success, a lot of successful companies don't collect very fast, but they pay their vendors very quickly. What we want to try to do is keep the balance, keep that heartbeat the same, in that we're paying and collecting on the same cycle. That's really what we're after, to get those two in balance. And that comes into our net working capital calculations that we'll go through. Inventory days, if you're a manufacturer, if you're a distributor, if you're a wholesaler, inventory is vitally important to you. And in companies that have a lot of inventory, normally they have some issues, either with certain inventory levels. So we work with companies on how to manage that better. But one of the things is a lot of your profit can be tied up in inventory, and that's why it's not in cash. So having the optimal inventory level is what we strive for, and helping companies calculate what that is. So one of the things that we will focus on today a little bit more is inventory. Net working capital, we'll go through some definitions, but that's crucial to your growth and improvement. Net working capital We'll go through the definitions, but that's really your short-term liquidity. That's your short-term financing in your business. These next metrics that we'll talk about, value added, is something that not everybody thinks about every day. We'll talk about what that is and how to calculate it. The true profitability. What does each product grouping or each service offering in your company make? Most companies have 3 or 4 or 5 or 6 different offerings that they have, what we call broad family categories of offerings. And we like to measure and say, what's the true profitability of each one? COVID-19, now that we're in that era, is showing a lot of companies what their true profitability is on certain segments of their business. And we believe in segment reporting. We don't want to just understand the whole business. We want to understand the sum of the business, what the individual parts that make up that business, how profitable are they, each one. Not every part of your business will be as profitable as the next, but we want to understand what that profitability is, the true profitability by business segment is, so that we can make decisions from it. Capital structure, we'll spend a few minutes on that. Your debt, short-term and long-term, and your equity. How balanced are those? Are you over-leveraged? Are you under-leveraged? Is your growth financing coming from outside the company, inside the company? What's ideal? We'll talk about some of those things. Contribution margin, some of you may know what that is, but it's really what's the next, on the next dollar of revenue or sales, what's my profitability? Is it a nickel? Is it 10 cents? Is it 50 cents? Some companies, the next profitable, the dollar of revenue might be 70 cents in profitability. So that's an important metric that we use. It's important to know what that is, and it helps you make better decisions. Finally, we'll talk about EBITDA. Some of you know what EBITDA is. It's earnings before income taxes, depreciation, and amortization. So it's really a measure of the core profitability of the company. It's also an estimate of the cash generating ability of the company, because it takes out some of the accounting, some of the GAAP measurements, depreciation and amortization, which are non-cash. It takes out interest. It takes out taxes, which interest obviously is how your company is financed. Taxes are people, you can set up different entities that have different tax structures, but we take those things out of the EBITDA measurement, add those back, so that we get what does the company really generate? What's the earnings capability of the company? What's the theoretical cash flow of the company? So that's what we do. Any questions on that? Do we have anybody you'd like to pause here for just a minute and take some questions? Let's see if anybody's chatted in with anything. David, did you see anything?
Nope, you're good.
Okay. All right. Let me get back where I was. All right. So we'll keep going. But again, we encourage questions. So don't hesitate to bring in some questions. We want to answer your questions. We think that makes this a lot more valuable for you when we can answer your questions. We're certainly not afraid of the question. We encourage it. All right. Okay. So this next chart, and this is also in your Excel package. So you'll have this, and you can use this individually after the presentation. You'll be able to see that. But this is just a very simple spreadsheet that we've created. And all of the data that you see here today are live data from customers we've actually been at. So we didn't create this data. We've disguised it for confidentiality. But these are actual company data. So we didn't make any examples to work out a certain way. This is just the way it worked out from live company data. This particular company has 105 days, you see on the first line, order to cash cycle. So that means it took them 105 days from the time they received an order until they had cash in the bank, 105 days. We determined for this company and their industry that the ideal was 75 days. So they needed to reduce that by 30 days. That was going to be their goal. Based on their sales value, they were averaging about $55,000 a day in sales. So that was going to be a 1.5 million cash opportunity for them. So that's huge. Now that order to cash cycle takes into account these other more detailed um, measurements, but that was their opportunity there from order to cash. But let's break that down a little bit. If you'll look, accounts receivable days, their average was 55 days, so they were a little bit extended on their customers. And we said in their industry, this company should be averaging about 33 days. So that's a variance of 22. That opportunity, $55,000 a day, $1.2 million. So that's very significant for a company. And this company might be larger than yours, it might be smaller, but that's a very significant number that doesn't have anything to do with their direct profitability. That's just in their ability to bring their accounts receivable in line with where it should be within their industry. So they were allowing their customers to have better terms than they really needed to. And we'll talk about customer terms and how that works and how you influence that. But that was their opportunity. We wanted to identify what's the opportunity in AR, $1.2 million, very significant. Their accounts payable turnover, we calculated that, and you see the formula there. They were paying people in 29 days. So they're collecting in 55, paying in 29. We wanted to get those more in line. We said their AP should be at about 44 days. That's generally about the maximum we recommend unless there's some extenuating circumstances. But we like to see companies in that 30 to 45 day period in accounts payable. And we obviously like to see them no more than 45 days on receivables. We'll talk about some industry exceptions, but to get them to 44 days, an improvement of 15 days, that was almost $700,000 in improvement. So there's 700,000 in AP, 1.2 million. So we're looking at nearly $2 million that they had the ability to improve just on their balance sheet. Didn't have anything to do with their sales or profitability, but that's $1.2 million of cash that was invested in that business, just in AP and AR, that they could pull back out and either pay themselves with it, or better yet, reinvest it in the business for growth. And that's the way we like to see that done. So that was their opportunity from those two. We look at the other big one for them. They were a manufacturing company. Days of inventory. They had 91 days of inventory. So they had quite a bit of inventory. And their average inventory was $4 million. It was a very cyclical business, so they had a ramp up period. Their inventory actually went up to about $20 million at the peak of the cycle and then came back down. But their average was 91. We said your average should be about 45. That was $2 million. $2 million that they had extra tied up in inventory. We'll come back to some of these other measurements, their gross margin and contribution margin, profitability measurements. They had opportunity there as well. But if you look at the cash opportunity, you go all the way down, $4.7 million, and only $800,000 of that is earnings related. The rest of it is just cash related from managing their balance sheet better. So that's some of the things that we help focus on. These are simple measurements, but they have a dramatic impact on the business. So $4.7 million was their cash opportunity. We'll go to our next slide. Let's see. Bear with me for a minute as I try to do that. Got a little bit of a delay here myself on this. Let me have one of my team members help me with this. I think that's it. Okay, all right. So here was their outcome. We did this, worked with this client just a few years ago. But by using these metrics and some of the solutions that we helped them with, $4 million inventory reduction, which was our target. So that was very favorable for them. They paid out their ABL facility. ABL is asset-based lending, so they were borrowing on their receivables and inventory. They paid that out in full. Previously, every year, they never got their ABL paid down to zero. At the end of the sales cycle, they should be able to pay off their borrowed short-term money in full. But they were never able to do that until they got their inventory back in line. So getting their inventory in line means they're able to pay out their ABL facility, to pay it down to zero. And then in the next production cycle, they could borrow money again and start back up. So that helped them avoid some interest, unnecessary interest. We don't mind paying interest when we're borrowing money, but when we don't have to borrow it, then we can save that. They had a net $3.2 million cash increase and $1 million earnings improvement with no sales increase. So their sales were flat. They did all of this on basically flat sales. That was in 2016. In 17, they had similar results. In 18, they actually improved from that a little bit. I don't know their 2019 results yet. I'm going to check with them and see. But the point is, these measurements are sustainable. And that's what we want to help you with, implementing some solutions in your business, measuring the right things, and making them sustainable over time. If it's a one shot, you get some benefit, but we want to make these sustainable over time. So the point is getting their AR, their AP, and their inventory in line, generated $3.2 million of cash, reduced their inventory, paid out their ABL facility, and they're able to sustain that for 3 years, and we think even 4 years. Okay, any questions? Feel free to have questions. Let me back up here a second. Okay, did skip a slide there. This just so you know, this business similar to yours, maybe family-owned business, second generation without a succession plan. We'll talk about things in minutes. You see, identified the opportunities: cash, inventory, ABL, supply chain, and there was a very seasonal business. So it was very important that they manage their inventory better because of the seasonality of the business. So this may be similar to your situation. Here's a little graphic from a buddy of mine on where all your cash flow can leak from, and it can leak from many places. So we talked about some of the big ones, but there are all kinds of other areas that your cash can leak from. So we say pay attention to cash flow because it's extremely important. We have some metrics around that. We've just been through some of those. So looking for any questions that you might have on that. I know it's a tough format. Here's a question. What types of actions did the company take to reduce order to cash days? Okay, very good question. Thank you, Vince. All right, so some of those actions are, we can look at how do we do our invoicing process? Are our invoices correct the first time they go out? Oftentimes, invoices are not correct. I learned that the hard way. I was working with a client, General Electric in better times was one of their customers. And we would send invoices to General Electric, and on about day, they had 60-day terms, couldn't be changed, industry standard. So we didn't try to change that because that was, if you're going to participate in the industry, that's what you do. But on day 58 or 59, they'd call me up and say, Bob, we've got your invoice. We're about ready to pay it. However, the purchase order number, which was like 12 digits, did not have -X on the end. And this is our X project, and it has to have -X on it. And I would say, okay, we'll put that on there. We'll send that to you today. And they said, that'll be fine. We'll put you back in the hopper, and it'll be 60 more days before you get paid. So I said, well, that's a severe penalty for having one character incorrect on a purchase order. Went through the next 60-day cycle, day 58, day 59, they call again, communicate with us and say, okay, on line 24 of the purchase order, we found another reference number that was incorrect. If you'll correct that today, we'll put you back in 60 more days. So we quickly learned that it was very important for us to get paid on time. Our invoices had to be perfect. So we had to go correct our internal process. Our first reaction was to say, wow, GE's really picky. Well, They may be if we're going to do business with them. So our correction to Vince was we took our process and said, what kinds of things are we doing wrong in our process? So we corrected our process. So we had people double check. Do we have all the information? Did we answer all the questions? Did we proof the invoice before it went out? So we put some extra steps in there that might have taken an extra day to do the invoice, but it saved us 59 other days because it got paid the first time and we didn't have to do a second or third revision. Now that was an administrative step. Let's go a step further. What can we do operationally? Vince's question was, what other types of actions did you take to reduce order to cash cycle? So when you go through and measure your order to cash cycle, you're going to see all the different components of your business. Like I said, pre-sales, pre-estimates, the estimating process, gathering information from the customer, talking to their engineers or their people, whatever kind of product or service you're in. So you may measure 15 or 20 steps that it takes you in the order to cash cycle. So what I would do is, first of all, pick some orders, measure the order to cash cycle, look at all the key components that are in there, and pick the ones that have either the longest delays or cause the most problems. And your staff will help you with this. I'll say, oh yeah, if we have a GE order, this event always occurs and it's always negative to us. So take that event, dissect it, and say, what can we do to improve that? We worked with a client recently. They're an IT service provider. The engineer in charge of delivering the service said, I never get a good scope of work from our pre-sales department. So we spent weeks working on that effort to say, what are we learning in our pre-sales effort that we're not communicating to our engineers? Well, the engineers were able to say, these are the top 10 things that always seem to go wrong. So we took their list, added to it, beat it up, and came up with about a 25-point checklist that we gave to the pre-sales engineers and said, on every order, make sure you answer these 25 questions. Tick them off that you've asked, put the answer down, and then when you turn that order over to us, the top 25 things are already completed. We already know and understand them. That took about 90% of the communication problem away. Didn't eliminate it, but it took it away. So that probably saved us 2 weeks or more in our order to cash cycle just from that improvement. It was communication. The pre-sales guys doing the right thing, the engineers doing the right thing, but we didn't pass all the information to them timely and accurately. Once the pre-sales people understood, I've got to answer these questions, this is going to make my life easier in the end. The customer's not going to complain. The engineers are going to get their job done faster. So that was an action step that we took to make sure that we had the right information internally. It wasn't the customer's fault, internally, and that reduced our order to cash cycle. All right. Anybody else? That was a great question. Thank you. So the moral of the story is dissect your order to cash cycle, determine what all the components are, identify what the top 2 or 3 problem areas are, identify what those are, and then you can start doing a deeper dive to say, and it's often a simple solution. Ours was a checklist. I mean, that's a pretty simple solution, but we do it on every order now with that client, and it works really, really well. Like I said, it doesn't catch everything because every order is a little bit different, but we took about 90% of the variable out, and now we can spend our time, trying to get better incrementally, get it to 91%, 92, 95, maybe you get to 98, but we went from about 50% to 90% in a matter of just a few weeks. So that was a big benefit. All right, any others? All right, we'll move on. All right, so let's go through a few definitions here. Contribution margin, we touched on that a little earlier. That's the profit on the next sale. It's simply the revenue minus your variable costs. We're going to go into detail on what those are, but that's the basic formula. So we're going to put a check mark by that, make a little note. Contribution margin, some of you may use that already, but it's something that we work with every client on, determining what their contribution margin is in total and determining what that is by each major product or service offering that they have. This is not, if you sell 1,000 products, this is not, you don't have to do 1,000 calculations, but they'll naturally fall into some families. If you have 1,000 products, they may fall into 4 or 5 different families or groupings or segments. That's what we determine it on. And we'll go through more detail of how to determine that. Value added is simply our revenue minus our material cost if you're a manufacturer. If you're a service provider, it's your service cost. If you own a legal firm, it's the cost of what you pay the attorneys that work for you. If you're an engineering firm, it's the cost of what you pay the engineers. Some of those services are outsourced, so you might have to subtract. If you're a contractor, it's minus your subcontractor fees that you have to pay. That's the value you're adding. That's what you get paid to do. In other words, you get paid to convert these inputs, whether it's labor cost or material cost or outsourcing cost. You get paid to take that cost, convert that into a product or service. And obviously what you have left over is profit. So they're paying you for the conversion. The customer could go buy the material. They could go hire an attorney. They could hire an engineer, but they're paying you to convert that input into their product or service that they need. What's our value add per employee? So that's our value add divided by the number of employees, or a more refined measurement is defined by the billable employees. On our IT service provider company that I was just talking about, we used to say our goal is $400,000 of revenue per billable engineer per year. So that's roughly $200 an hour at 2,000 hours. That's $400,000. Now, in reality, it takes about $225 an hour because we normally can't bill for 2,000 hours because there's training, there's vacations, there's some other things in there. But 400,000 was our ballpark number that we used as our target. So for 8 engineers that we were able to bill, that's $3.2 million in service revenue. That was our goal for the year. So what is our value add per engineer? In this particular company, an engineer cost about $60 an hour. So about $120,000 a year. That was their pay, that was benefits, that was their computer. It was everything that they needed. That's what it cost us to have an engineer. So we had about $280,000 of value add in that. Out of that $280,000, we had to pay for support people that we needed. We had to pay for building. We had to pay for other equipment. And then obviously what's left over is profit. But that was our goal. That was how we set up our plan in that company. So it was important for us to know what's our value add per engineer, and are we able to get the revenue per engineer that's our target. EBITDA, we talked about that a minute ago, the real cash generating ability of the company. EBITDA is a measurement that a lot of people from outside the company use. We encourage insiders, presidents, owners to use EBITDA, even though it's primarily used as a valuation metric on your company. We think it's valuable because it is your theoretical cash flow generating ability. So we encourage companies to measure their EBITDA every month, have EBITDA targets, EBITDA goals, and we do that at virtually every client. It's very important. We have a new client now that we're working with. We've already set them up on the measurement. It's a dealership group, and so one of the dealers called me just yesterday and said, "Bob, I don't understand why we have to measure EBITDA. Why is it important?" She says, "Because we've always just gone on bottom line profitability. That's what's important to us. What's our bottom line?" So bottom line profitability is important, but this tells you what your cash generating ability is, and it tells you what you really earn in the company. Now, this particular dealer had a lot of personal expenses that they ran through the company that had some company benefit, but they still ran them through the company. And we said, okay, we're not here to argue that point, but we add those back to EBITDA. We add back those sort of personal things that you're doing in the company. And that tells us what our true generating ability, what our earnings capacity is, what our cash generation ability. Then if you choose to do things with your earnings, that's okay. That's your business. But we want to know what your true generating ability is, because you may find that you're running too many things through the company, that you need to be retaining more earnings in the company. Or you may find that you're generating enough cash and those are perks that you're able to do, and that's okay. So having that separation and knowing what you're really able to generate or should generate, comparing that to your goal, we think that's vitally important. Um, we normally measure EBITDA for the whole company, but we measure contribution margin by business segment. Net working capital, most companies need some improvement in net working capital. I've often told business owners, if you have excess working capital, if it takes more money in your business, that's your money. You can draw that out or you can reinvest it in the business. But let's have a target. Let's decide what amount of working capital is required to run this business. What are your growth factors? How much net working capital is it going to take to grow your business to the next level? But let's not have excess working capital in there. Don't have it tied up in inventory and AR and paying your vendors too quickly. Let's have all that in balance. Know what our true working capital is. Many business owners don't pay enough attention to the balance sheet, and that's where working capital resides and how their company is financed. They think about, okay, how much debt I have, but how effectively am I using my net working capital, and do I have too much cash that I have to go borrow money that I wouldn't necessarily need if I managed my assets and liabilities better? True profitability of our product or service, we talked about that a little bit. We'll go a little bit deeper, but we want to be able to measure that on each major business segment. And then our overhead. If you have a financial background, if you've taken accounting classes or anything, they make a big deal about overhead allocations. We don't like to do that. We don't feel that our overhead allocation is any better than yours. And at the end of the day, an allocation is just an allocation. So I've had some clients say, we're going to allocate every penny of overhead expenses to a certain product or a certain segment. We don't think there's value in that. We'd much rather plan for a certain level of overhead, see how close we are to that, because an allocation to product A or B or C really doesn't matter. It's arbitrary. Allocations are arbitrary in nature. Accountants sort of get hung up on that. We don't like to do that. We want to measure the levers in the business that really make a difference. And overhead allocations, we don't think are value added, that they really don't gain anything. There's not a lot of extra knowledge there for you to make decisions from. So don't get hung up on overhead allocations. All right. After one of our breaks, we're going to come back and explore in more detail risk factors. Most companies, if you're in the insurance business, you live according to risk factors and measurements of risk. That's what insurance is all about. During COVID-19, as you probably know, and your own experience is, you're not driving as much. So automobile insurance are spending millions of dollars on TV now saying we're great humanitarians. We're giving back money because you're not driving as much. Their risk is down. I got $48 back the other day. Wow, the risk wasn't down very much apparently. As you know, insurance is state regulated. And so they're trying to avoid having to give a lot of money back by giving a little bit right now, and hope their state regulators won't force them to give more back because the risk is down. But we want to help you measure risk, and we've got an exercise we go through of how we measure risk. And risk can be subjective. We try to make it objective. We try to help you define what those risk factors are in financial, operational, and legal. So we're going to define it in all those areas and help you. Okay, Malcolm, appreciate your question. And he's asking about what metrics should we be looking at in the pandemic crisis? Okay, that's a good question. Excuse me. Actually, I think the measurements you look at in the crisis are very similar to what you would look at when we're not in a crisis. basic measurements hold true. And we're going to go through those today in more detail. We sort of touched on them. We're going to go through them in more detail. If you have a specific metric in your business that you're questioning right now, does this apply in the pandemic? We'll be happy to entertain that. But the basic ones are still going to hold true. Actually, and using these metrics, I think will help you in the pandemic crisis. For example, true profitability. Some companies are finding out during the pandemic crisis that what they thought was profitable really isn't. That when part of the revenue went away, all the profit went away. That they weren't making near the money on some product or segment as they thought they were. So I think in general terms, it's going to be the same metrics in and outside the pandemic. But good question. But if you have something specific, we'll look at it. I think maybe it's time for a break. It's not been quite an hour, but let's take a little break right now. It's 10 minutes. I've got about 22 after. So at 32, why don't we reconvene and we'll go into detail about these metrics. And if you have any questions during the break, just send those in. We'll try to answer them when we resume. But let's take a 10-minute break. Thank you.
You're back.
All right, we're back. It's been a little bit later now, so I hope everybody's back with us. Um, and first, let me apologize. This is difficult for me, as you can probably tell. I am so used to being in front of you as a group and seeing your faces and taking questions. So this feels a lot more one-way communication than I'm comfortable with. So please help me help you. Be sure to top chat some questions in. That'll make this a lot better for me and for you both. So don't hesitate. I'd rather have 100 questions than one or two. So help me help you. And again, I apologize. It's a new format, something I'm trying to get used to as well. I thought it'd be a little bit better than Zoom. Zoom gets a little unwieldy, and I'm one of the Zoom zombies. I've been on so many of those. So help us as we experiment with this and try to make this better for you. But anyway, let's talk about contribution margin. I get excited about contribution margin because it's a very valuable metric, and you can use it during the pandemic. The contribution margin, as we said earlier, that's the profit earned on the next revenue dollar. That's critically important. If I go out and sell one more dollar, or 1,000, or 10,000, or 100,000, or I lose revenue dollars, which many companies are doing during the pandemic, what's that effect on me? So we have to break that down. We break it down into two components. We break it down into fixed cost and variable cost. So we've listed some variable costs there: direct material if you're a manufacturer, if you're a contractor, direct labor, outsourcing of direct activities, something that's core to your business. Commissions, people often don't think commissions are part of variable costs because they vary with the revenue that's earned. So commissions in many companies are variable, they're not fixed. And then any other cost that you can think of that changes when your revenue changes. So those are the things that are variable. I have a very simple exercise I go through with clients. We sit down with their income statement, or maybe we throw it up on the screen and we go through it in the conference room. You can do this as well. And we go down every item in that P&L and we list, is this variable or fixed? And we do that with every line item. And some of you have already said, well, some of my costs are both fixed and variable. And that's true. Many costs are. But what we try to do is make this binary, try to get them in one category or the other. What's their predominant? If I go change the revenue dollars today, will that cost change? For those we have listed, yes, that's going to change. Now, I've been with clients that said, well, hey, my labor costs are fixed. Well, they might be in the short run. They might not be in the long run. So labor, if you're a contractor, your labor is very variable because you're hiring labor as you have projects and as you have work. If it rains, you're not paying for that labor for that day because they couldn't come to work because it rained, whatever those reasons are. Other businesses, they're paying employees even if they don't have work. So they've made those costs fixed. But I try to look at it, if the revenue changes, am I going to have to hire people? My revenue goes up significantly. Am I going to have to cut people back if it goes down significantly? So some of my labor is variable, some of it's fixed. Try to separate it in those categories. For those of you who have your P&L set up at the gross profit level, that becomes a little bit easier. Normally, labor above the gross profit line is normally variable, below tends to be more fixed. Can anybody think of any other costs, or do you have a cost in your company that you're wondering if it's fixed or variable? Send that in and we can talk about that specifically. But if you'll go down your income statement with your accountant, controller, CFO, outside CPA, whatever you use, wherever you get the bulk of your financial information and answered questions from, separate your cost into fixed and variable. And then the calculation is simply revenue minus your variable cost is your contribution margin. Many companies have a pretty high contribution margin. It might be 50, 60, 70% on that next dollar of revenue. Their fixed cost might be high or low, depends on the business structure, depends on the infrastructure. I keep going back to the IT client that I have. Their costs were variable on the engineering side, but they also had a business segment where they sold hardware. They sold servers, they sold switches, they sold that kind of gear. Uh, that cost was 100% variable. If we don't have an order for hardware, we're not buying hardware. So it was custom ordered for a particular client, a particular contract. So if they lost a product sale, 85 or 90% of the cost of that sale also went away. So what they really lost was the 10 or 15% margin, the contribution margin. That's what they really lost because they avoided all the cost anyway. So they had a very low contribution margin on those product sales. But then if it went away, they only lost the margin. They weren't stuck with any of the hardware costs because they simply hadn't bought it for a job that they didn't get. So that was much different than another segment of their business, which was called an MSP. They were a managed service provider. In other words, they provided a help desk. So they had a group of employees who were in the office. They had a phone, they had a computer, and people would call in with questions. Now, this particular company, it wasn't necessarily hey, Windows crashed, or I can't get my printer to work. More basic customer-oriented questions or consumer-oriented questions. They were getting calls. Their help desk was set up to serve IT professionals. So they would have the IT manager of a client call in and say, hey, we just had a server go down. What are the steps I need to do? And they would have an engineer walk them through that. That business was very high in fixed cost. In other words, we had a group of employees, 5 or 6. They were being paid every day, all day. They might get one phone call. They might get 100 phone calls. So that business had a very high fixed cost and very low variable cost. So the contribution margin was very high on that business, the exact opposite of what it was on the product side of the business. So they sold subscription services for their help desk. So once they got above a certain level of subscriptions, break even, it was almost, I think I calculated it was 92% contribution margin on that business, because basically all they had to do extra was to pay a commission on the sale. All the other costs were fixed. So it had a very high contribution margin. So it was to their advantage to go out and spend a lot of sales effort bringing that business in, because it was so profitable until they got to the point that they had to hire another employee. And then, of course, that reset the cost, but then the contribution margin went back to 92%, reset their fixed cost. So that's sort of the bookends. The product business being a very low contribution margin business, the MSP part, the service desk, being a very high contribution margin business. Then they had project services, the engineering services, that was about 30% cost, about 60 to 70% contribution margin on that business, because it was high value engineering services. So that's really, that in the MSP is where the growth came from their business. They were trying to grow their engineering services, both help desk and project services, trying to minimize the product business, although the product business, when they got product sales, that automatically provided engineering sales and service. So they had to keep the balance of that. They couldn't go too extreme one way or the other. All right, so any questions on contribution margin? We're very, very big on the data of contribution margin. Again, go through your income statement with your financial person, separate your costs into fixed and variable by product segment, determine what your contribution margin on each major business segment is in your business, and you'll be surprised. Some will be high, some will be low, but that gives you some information about where you know the market opportunities probably in your industry, and if you know your profitability, you know where you can tend to put more of your efforts to grow your business profitably. Sometimes a low margin business, if you can generate a lot of volume with it, can become a very profitable part of your business. So, but knowing the differences between what your margins are, your contribution margin on the various segments of your business is vitally important. All right, let's talk about value added. Value added is the margin after the required initial costs are incurred. So customers are willing to pay for a product or service plus conversion. That's what they're paying you to do. You're buying labor, you're buying materials, you're buying services. The customer's paying you to convert those inputs into some sort of output for them. So all of your overhead, all of your conversion costs have to be covered plus a margin. And conversion is simply the final form, fit, and function and delivery of whatever your product or service is. So the value added calculation is simply your revenue minus that material cost, your service cost, or your subcontract cost. Then that's your value added. That's really what you're paid to do. That's your core deliverable to your customer. That's the value you're adding. And that's on the theory that most any of your competitors can go out and buy the material, the service, and the subcontract at about the same prices that you do. Now that's not 100% rule. A much larger competitor can get, a little bit better pricing in some industries. So size does matter of your competitors, but generally it's going to be somewhat close to the same. So how you manage your business, how you manage your conversion costs, what your profitability targets are, that's the value you're adding. So if you're a manufacturer, that's your material and labor and subcontracting cost. If you're a professional service provider, it's the base cost of the professional. So like we used in our IT company example, that's the $60 an hour. That's the $120,000 a year. That's the cost of our professional service. So if we're charging $400,000 a year on average, and we're paying $120,000, we have $280,000 that we have to convert that engineering input into the output. It's got to take the cost of our building, our equipment, our support people, our customer service people, all of that into consideration, and then our profit. So the less it costs us to convert, the higher our profit margin. In retail, it's your merchandising cost. As we said, MSP, a managed service provider, perceived value of the service. In other words, people buy blocks of time, and it's a perceived value. I don't know if I'm going to use 10 hours a month or 100 hours a month of service, but that has a value to me as a customer. I'm willing to pay a certain price to have those people basically on standby. So whenever I pick up the phone, somebody's going to respond. Or if it's a company where you go on site, then I'm there in 1 hour or 4 hours or whatever the deliverable is. So that's more of a perceived value. What's it worth to have somebody? I'm on standby with a client one day next week. They're going to have a big client meeting. They said, Bob, we want you on standby for 4 hours in case we have questions. And we're going to call you, or we're going to have you dial in on a WebEx and help answer our questions as we're going through making some decisions. So there's a value to that, a value for me being on standby for that client to help them navigate through. So that you may have value added, you may have some sort of service like that. So you can always then take your value add that you've determined for your segment or your whole business, divide that by employee, and then that's what your value add per employee is. When you look at your value add proposition, compare that to what your cost of employees are. So if your value add is 50,000, but your cost of employees is 60, you have got a negative value add. There's something wrong in your business model. Either you're not charging enough, it's not a needed service, or you're paying too much for it. So value add per employee is another metric that you can use, even in COVID-19. What's my value add per employee? Employees fall into two categories. They're either generating margin for you, or they're trying to retain margin for you. And retention is as important as generating. An example of retention is, let's say you have what I call compliance employees, your accounting staff, health and safety, HR. All those are activities where you have to comply with governmental rules and regulations, industry requirements, outside reporting requirements, internal measures, internal standards, processing of data and information. Those are compliance employees. You can't run the business without employees who keep you in compliance with all the different regulations and rules and processes that you have. You have many internal processes that your compliance employees have to follow to make things smoother. Compliance employees help you reduce your order to cash cycle. Compliance employees are responsible for filing tax returns, generating financial statements, capturing information, following new laws and rules and regulations. Just think of the Paycheck Protection Program. You know, what a compliance nightmare that's been. Well, we've helped several clients with that. And, you know, some of them have run into a lot of trouble just in the bureaucracy of trying to comply. Others have sailed right through. Sometimes there's no rhyme or reason for that. And sometimes it's things the client's done wrong. And we've tried to help some of them navigate through that process. So we're helping them retain margin by retaining or generating some replacement income during that time, which is also, and for some of them, it's helping generate some margin during the short run. So you can group your employees into those two categories: margin generating and margin retention, and measure the value add overall. And don't think that the value add is negative for your margin retention employees. You have to have those employees as well. They're as important to your business. We rank generating margin and retaining margin as equal. So keep that in mind as you go through value add calculations. Any questions on those? Send those in. We'll try to answer those. But value add is not something that everybody does, but we encourage people to use that metric. It's an important metric. It's one you can use during COVID-19. You know, sometimes you have to look at decisions about employees. You know, who am I going to retain? If I'm running out of cash, who do I retain? I've got to retain margin retention employees. I've got to retain some margin generating employees. I keep going back to our IT client. You know, their market is dead right now. You know, they're not selling big projects because their customers are too scared to make a commitment. So their sales force is just trying to keep the clients that they have now, keep them happy. Are you having service issues? Do we need to work on something? They're not out chasing new business because their clients, all their projects are on hold. So the sales force has gone from generating margin to trying to retain margin and not lose any clients, maybe have a little bit of extra service to clients. We're trying to help them think of ways that they can maintain clients. What can we give away for free that it's already costing us to have the employee there? So what can they do? What can the employee do to help them so that when this crisis is over, they remember us and say, well, hey, they really helped us out during a tough time, didn't charge us anything extra. That's a retention agreement. So we're trying to help that as well. All right, let's move on. Some of you, we mentioned this earlier in the highlight section, EBITDA. We're really strong on EBITDA because we think that's a great measure of theoretical cash flow and earnings capacity. We have another new client right now that we're working with, this dealer group that I mentioned earlier. EBITDA is going to be one of the chief measurements that they're going to use going forward to measure the success of. It's a group of dealers that are rolling up to become a super dealer because their industry is consolidating dealers, and small dealers aren't going to be able to survive. Their manufacturing vendor supplier can't afford to maintain a large network of small dealers. They've determined they can afford to maintain a small network of large dealers. So the smart ones are combining on their own. And we've been asked to help one of those groups combine and roll themselves up into a sort of a mega dealer or a super dealer. So EBITDA is going to be one of the measurements we're going to use to value their companies, and it's going to be one of their performance measurements. So as we said before, earnings before interest, taxes, depreciation, and amortization. So we take out the GAAP measurements of depreciation and amortization to get us back to theoretical cash flow. and we take out interest and taxes so that we take out the financing cost of the business and we take out the taxation. So we look at the business in a pure light. What can that business generate in earnings? All right, good question from Malcolm. Can you give us some parameters on multiples of EBITDA on buying and selling our business? Yes, we can do that. The dealer group we're working with right now, we're conservatively for them looking at multiples of 2, 3, and 4. We think that's pretty representative in their industry. Now, when we look at multiples, for those of you who may not understand what a multiple is, many companies are valued in the marketplace, and let's make a distinction here. The accounting profession has a valuation process. It's very well defined. There are many standards about how you value companies. They use EBITDA as one of the components of that. And so for partnerships, for combinations, for buying and selling, when you have a third-party valuation effort made, they have professional standards that they go by and go through a lot of calculations. And that's a process. The EBITDA and the EBITDA multiple is generally how the marketplace values a company. So what that says is a company is worth its ability to generate cash. Now, you have companies that say we're a financial buyer, we're buying a cash flow stream. And then you have other companies that say we're synergistic buyers, we're buying because this company fits our target of where we want to go. It's in our industry, or it's in a related industry. It has some internal synergies. And that's true. But at the end of the day, even a synergistic buyer becomes a financial buyer because they're paying a sum for a cash flow stream. Maybe they think it works better. They're willing to pay more because there's synergies there than a standalone buyer, but they still have to say, here's what we're paying, and we're paying for a cash flow stream. The multiple says, how much are we willing to pay for 1 year's cash flow stream over a multi-year period? So the EBITDA is 1 year, then the multiple says 1 year, 2 years, 3 years, 4 years, 5 years, 10 years, that we're willing to pay 10 times what 1 year's theoretical cash flow or earnings capacity is. So in some industries, 2, 3, 4 multiple is standard. In other industries, 10 is a standard. Some industries, it's 20 or 25. Depends on the industry. The more technical the industry is, the more innovative the industry is, the more high tech, the more that they think the future is, then they're willing to pay more. A good example of that is you look at Tesla. Tesla has now a higher valuation than any automotive manufacturer in the world except Toyota. So people are betting, the marketplace is betting that electric cars are going to be very significant in the future. So Ford, GM, Chrysler, Toyota, Nissan, Fiat, all the big players have some sort of electric car conversion or development program. They all recognize this, but Tesla, in the market's mind, is leading the way. They're the most innovative. They have more cars out there, electric cars, than anybody else in the marketplace. So they're worth a very large multiple of their EBITDA. Seth just said 25 works for him. So he's happy. His industry must be 5. He's happy with 25. So, but let's talk about the math of a multiple. So some companies say, I want to make another, let's just say we make $5 million a year. Well, no, let's say we make $1 million a year profit, and we're doing all we can to make $1.1 million. Okay. So now if our multiple is 5, our valuation then has gone from 5 times 1 million to 5 times 1.1 million. So the value of our company has gone from 5 million to 5.5 million. Okay, so that's good. That's a 10% increase. That's good. But if we go to 2 million times 5, that's a $10 million. So we doubled our profitability and we doubled our value based on our same multiple. But mathematically, it's more important to raise your multiple than it is to raise your EBITDA. because it has an exponential effect. So let's use our example. 1 million times 5 is 5 million, and 2 million times 5 is 10 million. But what if our multiple went from 5 to 10? Our $1 million of earnings times 10, now the company's worth $10 million. We didn't make any more money, but our multiple changed. So what are the things that change your multiple? Your multiple gets changed by, are you the top 1 or 2 or 3 companies in your industry, in your geographic area? Do you have an A customer list? Are you innovative? Are you putting money back into your R&D efforts or your product development or your service development? Are you using the latest technology internally? Are you relating to your customers better than your competitors? I hate to say we need to have more Twitter followers, but if you're in a business that social media means a lot, then are you doing those things in social media better than all your competition? Those are the kinds of things that raise your multiple, and that's what exponentially makes your company more valuable. So is it right to work on your EBITDA? Absolutely. That's an important measurement. But if you can work on the multiple side, that's even better. So we see companies, particularly on private equity. Private equity loves the EBITDA model. And so they will look at a company's EBITDA. They'll look at the past EBITDA. They'll look at the current EBITDA. They'll forecast the EBITDA into the future. And then they decide, what multiple is that company worth? Well, if they're buying, and you have to think, a lot of private equity firms are buying up right now, they're buying regional firms. So I was hired by a private equity firm to go in and help transition family-owned business that they had paid a high multiple for because they like the company's customers, they like their service offering better than any of the competition in a multi-state area. They were the leading provider, and this was in the fire security business. So they installed sprinklers, they did monitoring, and they had several different industries they served. They had 300 employees. It was about a $30 million company. And the private equity firm was willing to pay a premium for that company because they had an A customer list. They were the best in a 3 or 5 state area. The owner was willing to stay on and help them grow the business. They gave him some equity in it, wrote him a nice check, gave him some equity. He's going to stay on for 5 more years and grow it to the next level. So those are the things that make your company more valuable. So knowing what your EBITDA is, understanding what the multiples are for the average as well as the better companies in your industry, helps you decide, how do I now invest, instead of making another 100,000 a year, making my company 10% more valuable? Maybe I invest that 100,000 in my business and get my multiple to go from 3 to 5, or from 5 to 7, or from 5 to 10. Investing in my customer list, my technology. I see a lot of companies that say, hey, I'm going to make the most money because I'm going to do the cheapest things I can do. Well, that works in the short run. But if you're falling behind your competitors in terms of technology, in terms of customers, in terms of innovation, then you're depressing your multiple. You say, well, I'm not concerned with selling my business. Every business sells or closes at some point in its life. It's just inevitable, like death and taxes. Companies get absorbed, they get purchased, or they go out of business. So it's better for you to work on your EBITDA and your multiple, make your company more valuable, so that as an owner or as a key executive that you may have equity interests, or you may just be trying to please your owner, that you give that owner more options on what they can do with the business. Even if they want to pass the business down to other family members, they're passing something more valuable down to family members. We work with clients on exit strategies. Now, we let a lot of other CPAs and attorneys work on succession planning from a legal and financial standpoint. We work on succession planning from, how do we pass this business successfully to another entity or to a new generation of owners? And how do we set up the business so that it's sustainable, so that it's more valuable and the next generation can take it and make it even more valuable for the following generation. For a generation to survive 3 generations, the likelihood is in single digits. And we're trying to change that. We've had several 3rd-generation business clients, and helping them get ready to go to the 4th generation, pretty exciting. And it makes the more valuable the company is, then the more exit strategy, retirement strategy can be planned for the current owners. In our dealer roll-up example, that's one of the things we're trying to do. Most of them are 1st or 2nd-generation business owners. Almost all of them want the next generation to have the business, but they also say, I want a payday out of this. I've got to retire. I want something. So if we can help them make those businesses more valuable, now there are more options about how those children, those adult children, the next generation, can not only have the business, grow it and sustain it, but how they can help their parents then have a retirement. So we get the best of both worlds. The kids get the business, it's valuable and growing and sustainable, and the parents get to retire and have money in their retirement as well, without having to sell the business to a third party and the kids have to go find something else to do. So we get really excited about those kinds of things. And that was a great question. Thank you, Malcolm, for asking on multiples, what the values of multiples are. I can't tell you specifically in your industry. It takes some research to do that. But I can tell you in general that you want to work on understanding what your multiple is and how you increase your multiple. And you increase your multiple, like we said, customers. People think I don't ever want to lose a customer. Sometimes the best thing you can do is to lose a customer. If you're losing money on a customer, if it's a customer that gives a lot of trouble, you need to look at your customers, and maybe you need to lose 5 or 10% of your worst customers every year. One of the things we do, and we're going to talk about this some more, is pricing. Sometimes if you have, let's call it a problem customer or a challenge customer or a customer that's more demanding than you like, sometimes increasing the price actually makes them a better customer. They take notice, okay, I'm willing to pay more so I can expect more. You're willing to give more service because you're making more money now. And we've often seen that aligning the price with the value of the service or product is actually a win-win for the customer and the client. And we're going to go through what we call a pricing triangle or a value triangle here in a few minutes. And we'll explain that in more detail. But great question. Work on the multiple. Let's go through a little bit more of the definition. We probably hit these points, but let's just make sure that everybody's got them. This is another good place to take a note, either on the structure, on the presentation or in your notepad. Is the cash flow generating ability while holding the balance sheet constant. And so we say, okay, we're not going to change the balance sheet in our calculation, but we're going to understand what the cash flow generating ability before we do those other things that we talked about on inventory and AR and all those things. We add back our non-cash GAAP requirements, and we want to work to constantly improve our EBITDA and our multiple. And as we said, the earnings multiple is based on your specific industry and your differentiators. I sort of tripped over that word. The things that you do better and different in your industry. You can't change your industry multiple. You can only change your multiple within your industry. You're in the industry you're in. To change that whole industry, most likely. You can change your position in the industry. Okay, here's a question from Chad. Thank you. Are you seeing deals, sales of businesses, put on hold due to coronavirus, or are pending sales still more or less going through over the past few months? Another great question. Thank you. I'm seeing those deals put on hold. Many private equity companies, they have determined, are not eligible for a lot of the government financing, the short-term financing through payroll protection and other programs because of their size. I know I work with a private equity company that's probably $2 billion, but they buy $30 million companies. So their $2 billion portfolio is comprised of many, what we would call small to mid-sized businesses, mid-market companies, $30 to $50 million in revenue and value. A lot of those deals are on hold because the financing has dried up. Some of them are going through. The best deals are going through, but most deals are not going through right now. Do I think that'll change? Yes. I think I'm an optimist by nature. I think we're going to go through this Corona thing sooner than later. I think there's a big push nationwide for people to get back to work, and you may have different opinions about the politics of that or the health of that, but it's coming back. Probably not as fast as I'd like for it to, but everything I'm seeing is saying it's coming back, and deals will start resuming as well. You know, the big deals get the headlines in the Wall Street Journal and the New York Times and maybe even your local publications. Big deals get the headlines, but there's thousands of smaller deals that really make up the market. The headlines are dominated by a few deals, but the market's dominated by many, many deals. So a lot of them are on hold right now. The best ones will continue to go through. The top 2% will continue to go through, but the rest are generally, I'm seeing they're on hold right now for financing. Plus, people are rethinking, okay, is this a business I want to be in now? You know, if you're in the airline industry, you're in the travel industry, you know, it's you know, 100-year issue right now. Other businesses, their revenue's actually up. You know, if you make toilet paper, if you make hand sanitizer, you know, your business is up right now. But most businesses are struggling right now of all sizes. You know, look at Disney World. Who thought Disney would close? And they're not going to open real quick. They've opened in Shanghai now on a limited basis, but California and Florida probably they took reservations for June. They've now given those deposits back. They're looking at July or August now for sort of a soft or gradual opening. Are those good long-term businesses? Absolutely. Absolutely. But for each one of those, there's hundreds or maybe thousands of suppliers that their business is down because that big business is down. So yeah, deals aren't going like they used to, but they will come back. They'll come back, I think, fairly soon. You'll start seeing more and more activity. But now COVID-19 is a great time for you to work on your business. And be ready as business comes back to handle more business, to look at customers in a different way, to look at industries you haven't been in. That's one of the values of contribution margin. If I know I've got, let's just make up a number, 60% contribution margin, I can go to another industry, a related industry, and say, wow, I could cut my price 10% and I'd be making 50% margin on that. I'd cut it 20%, you know, I'd be making 40%. That's an opportunity for me to get in and buy a little market share and then try to grow that business. Now, don't go to the extreme. Don't say I'm making 60%. I can cut my price 50% and make 10%. You don't have enough to cover your overhead now. So understanding what your overhead is as a percentage of your contribution margin is important. But you know you've got some play and being able to use that to your advantage to get in a related business or related industry. Pretty strategic thinking, especially right now. Most businesses are hunkering down, but if you're one of the ones that can look and say, okay, there's an opportunity in this dark cloud, those are the businesses that'll come back quicker. So our IT client that we have, they got the Paycheck Protection money, quite sizable amount because they have a really large payroll. But what they're doing right now, they've kept everybody on the payroll, and they've converted and said, okay, one of the things that one of our engineers did was set up a training and skills matrix for them. So he said, okay, here's all the skills that are needed throughout the company. Here's every engineer that you have. Here's the ones that they're at the training level. They can teach other people. They're proficient. They can do the job in that skill area. They're average at it, or they need more training, or they have zero training in that. They don't know how to do that particular task at all. So we got all the engineers on a board. We've got all that laid out in a grid. So now we know who needs to be trained in what areas, and we've prioritized that. So during this 2.5 month period that they've been paid, they're going through an aggressive training regimen. And so when they come out of this, their engineers are going to be able to deliver more value quicker. We're going to be able to charge more. because we have a much more assortment of trained engineers. We had products and services that we offered that only 2 of our 8 engineers knew how to do. They were overworked, everybody else was underworked. Now we can spread that work out, which means we can turn jobs quicker, which means we can accept the next one, which means we can get paid faster, and we can have more revenue coming in for the entire year. So they're really looking at a pretty strong third and fourth quarter, because they're using the last part of the first quarter and basically all of the second quarter to retrain their entire engineering and technical staff. So that's a really good use of the COVID money, the PPP money. And it's something we encouraged, and they were going to do it anyway, but we helped them get, here's the priorities, here's who you need to train, here's what they need to be trained in. And that's working really well for them. They're, got about another month of training that they're going through. And fortunately, a lot of the training is online and a lot of it's internal. So we've got our 2 engineers who were buried in work. Now they don't have the work. They're now training a lot of the more junior engineers up to their level on the key tasks. So that's a good use of the money. So thanks for that question, Chad. We got into some other issues, but that was a great question. Anybody else? Questions on EBITDA, on multiples? And you all seem to have more questions about COVID. I'm sorry I don't have specific answers on COVID. I don't know anybody that does. We don't know what the future is. All we know is it's a crisis. If ever crisis, there's opportunity, and we need to figure out where our opportunity is for each one of you. And if again, I'll throw out my free offer. If you want to discuss your particular business situation, we'd be glad to do that offline. If you have a specific question, that's fine. If you want to discuss your whole situation, we'll do it offline. But for every crisis, getting back to basics is very important. What we like to call blocking and tackling. We play a little football up here in Tennessee. We like to say we gave you Ed Orgeron. So he was one of our coaches for a year. So he's got a great following in Tennessee, even bigger following in Louisiana. So we like to see him do well. But basics, blocking and tackling. When business is in a crisis, go back to the basics. Make sure you do the basics right. Make sure your folks are trained. Make sure that you're looking for the next opportunity, because there'll be opportunities out there. All right. If you've got any questions, send them in. There's a little bit of a delay here. Okay, net working capital, and we're coming up, getting close to another break here, so we'll take a break, another slide or two. All right, Malcolm, go Tigers. I like it, GAUX. All right, I love it. All right, and I cheered for them in the national championship. We were going to be on the side of the winners. All right, net working capital, short-term liquidity of the business. So that's really what it is. The calculation is simple: current assets minus current liabilities. My formal training, first set of training was in accounting, and accountants like to make things complicated. So some of them will add some things into current assets or delete some things from current liabilities. Don't get hung up on that. Just go to your balance sheet and say, what's the pure number? Current assets minus current liabilities, net working capital. Now, I see some more questions coming in. Let me make one more point. We'll go to the questions. Current assets, if you're not familiar, go to your balance sheet: cash, accounts receivable, inventory. You may have some prepaids in there. That's a current asset. Current liabilities, accounts payable, your accrued payroll, other accrued expenses, and your current debt payments. All those are considered your current liabilities. So current assets minus current liabilities, that's your net working capital. It may surprise you how much that is. What we like to help clients do is determine what's their optimized working capital level should be at this point in their revenue picture. And then what should it be to grow? How much working capital does it take to grow? Remember, whatever your net working capital number is, that's the amount of money you have invested in that business on a short-term basis. It's your money. So if you can reduce your net working capital requirement, that's money you can either put in your pocket, or that's money that you can reinvest for growth into your business. So most people have too much working capital in their business because they're not efficiently managing it. AR, inventory, accounts payable, the big three of how those are managed. No, All right. So I've seen a couple things come in. It's a time to live to fight for another day. Yes, that's true. If your customers have dried up right now, your projects are on hold, it is time to live to fight for another day. So look at your fixed cost. What fixed cost do I have that I should eliminate in the short run and or eliminate in the long run? And knowing what those are and what those cost help you make a decision. We often think of things sort of in the abstract and say, oh gosh, I got rent, I got this, I got this. Write them down, model them, decide what they are. Our IT client that I keep referring to, they've now decided we don't need the building we're in. We can work from home remotely just as well as we were working before. Now, I might challenge that a little bit, but the crux of that is they don't need the size building that they're in and paying rent on. They need to go to another facility, a smaller facility with less offices, less cubicles, more conference rooms, so that when they get together, they're in small groups and teams working on solutions or opportunities. They'll have a few cubicles that people can come in and say, I need to work half a day in the office, and then I have a half a day meeting. Things like that. We can bring customers in, we can bring vendors in, but they probably need a third of the space that they're currently paying for. So on a long-term basis, they're now going to negotiate out of that lease, get to a smaller facility is what they're seriously thinking that they're going to do. And I think that's good. Nothing demands that they have 42 employees in the office every day. They may need 5 or 6 employees on a different basis in the office, and then room for when they have a bigger groups that need to come in at the same time. So that's their plan. So that's one way they're going to start reducing their fixed cost. They don't want to reduce their number of employees. They're convinced that their market is there, that it's growing. I think that's a good move. But they have identified, and we helped them identify this. They've looked at, of all things, commission cost. Commission cost is a large cost for them, and it's out of proportion to their industry. So by looking at their industry metrics, and they've now decided we're pretty well in line. We're a little high here, we're a little low here, but we're generally good. But our commission is something we have to work on. So we've helped them look at other types of commission plans, commission payments, how they compensate their employees. And one of the things we're helping with is to say, we don't want to put a ceiling on what somebody can earn, but we want to put the higher commissions on what we think the future product and service offerings are. In other words, if we're trying to pivot and reduce our dependency on product, and we want to sell more project engineering services and MSP services, then let's put higher commission rates on those products and services, or those services, and less on the product side, so that we match the financial incentive with where the strategic objective of the company is. That's things you can look at in your company as well. So, it's great to have a budget. We like to call it a plan. Budget sort of sounds archaic, and it sort of says, oh, it's just a numbers thing. We prefer the word plan because it's marketing, it's sales strategy, it's financial, it's operational. It takes into consideration all these things. The financial part is just how we're going to pay for it and what it costs us, so we know. But it encompasses all these other things. So having that plan and knowing what that is vitally important. So we want to be able to help them do that and create a structure, a commission plan that supports where the sales and growth objectives of the company are. That's something you can look at in your company as well. Your commissions may be in line with the industry, and if so, that's great. But you probably have something that's out of line. And that's where you need to start and focus on those things that are causing you differences. This company was in line on almost all the metrics except commissions and earnings. So it's a pretty simple solution to say, we're paying way too much in commissions and it's coming out of our bottom line. We may have to pay more than the industry average, but we don't need to be paying 50% more than the industry average. So those are the kinds of metrics that we look at there. trying to get that, won't be perfect, but trying to get it more in line, raise our EBITDA number, which because they have an A customer list and they are innovative and they do use the right technology, now their EBITDA multiple in their industry probably goes from 10 to 15 without a tremendous earnings improvement by just straightening out some of these issues so that a new buyer, if a new buyer comes in, and by the way, the owner wants to sell it to the employees, which is a very good thing, but he would want to be compensated by the employees over a period of time for what he's built with their help, make them owners, still get a payday for himself. So it's actually for him, he will get more money with a higher multiple. You say, well, the employees are going to pay more, but what they're paying for, it's going to be worth more. It's a more valuable company, which means if they can grow it and make it even more valuable, they'll get a bigger payday someday out of it as well. So that's some of their objectives, to keep it employee owned, but to grow the earnings and grow the multiple at the same time. So that's part of their objectives. And they're having to convince the sales force this is in your long-term best interest. You're going to take a little less now, you're going to have much more in the future. All right, had a couple of questions come in. Thank you for those. Vince says moving to more off-site workers, the need to measure that productivity is more important than ever. What types of measurements are you seeking to help understand the effectiveness of distance workers? And then a second comment to that is also with support type positions. So that's a great question. Looks like it's time for a break. Let's take a break. If you have more questions, send those in. When we come back from the break, we'll answer Vince's question and any others that have come in, and we'll continue going. So I've got 27 after. Let's just make it 20 till. We'll take 13 minutes. Let's make it 20 till, come back, and we'll see you in a few minutes. Have a great break.
You bet.
All right. Hope everybody's back from break. It's always good to get up and stretch for a few minutes and check on the dog or the cat or the kids or whatever's going on. I'm assuming everybody's at home, or a few of you might be in your office. So anyway, let's go back. Oh, I see. We had a 5 C's for turnaround: control, cash, customer, culture, connection. Yeah, I agree with that. That's good. Defense, run lean. Offense, innovate, create new revenue streams. All good stuff. All good stuff. Let's answer Vince's question. Let me repeat it. Moving to more off-site workers, the need to measure that productivity is more important than ever. Very true. Thank you, Vince. What types of measurements are you seeing to help understand the effectiveness of distance workers, especially with support type positions? All right. So the short answer is we need to be using the same metrics at home as we were at work, in the office, in the factory, wherever we were at. But because we were assuming we were profitable before COVID-19 and had at least adequate cash flow, we may not have been measuring all those positions. So again, like we said earlier, back to basics. If you've got people working at home and you didn't have a metric on them at work, now's a good time to develop the right metric. So let's take an example. Say you have a sales position and they're at home now and the market's dried up. And I think many of you have probably been affected by COVID-19 in a very negative way. And they don't have anybody to go sell to. None of their former customers are buying right now. So they've had to switch from margin generating to margin retention. So if they've got key customers for you, what is the margin on those customers? What was it before COVID-19? So how valuable is that customer to you? Is that $1 million customer that you make 10% on? Is it $1 million customer that you make 50% on? Do that kind of sort of high level metric and then say, how much time do I need my salesperson to spend making sure we retain that client? So I'm paying that customer, that sales position, either a flat salary or salary plus commission or PPP money. You have some compensation expense out there. Decide what that is. Decide what the margin is on those customers. Decide what order it needs, the priority is, and then say, I want you spending your time making sure we retain these 10 customers or these 100 customers. I want you to touch them every day. I want you to touch them once a week. Whatever frequency you decide is best, or maybe together you decide that, and then use that to develop the metrics. Because even the sales game is, even though it's relationship selling in a lot of cases, it's still a numbers game. We've got to make so many touches. We've got to make so many contacts. We've got to solve so many problems. We've got to find out what their real needs are, where we can help them right now. So that's the kind of metrics I would recommend for, in that one example of an at-home worker. Let's take an administrative person. Your accounting effort, let's say. Are we processing the number of transactions per day that we need to? Are we getting our reports out on time? Or maybe we can get our reports out earlier. See, I think efficiency at home can actually be higher. There are actually probably more distractions at home for most people than there are at work. But when you have the quality time at home, you can probably get more done in a set period of time. So if somebody can say, I'm going to do nothing but work for the next 2 hours, no kids, no pets, no spouse, 2 hours of full concentration, I call it a power hour. For me, if I can spend 1 hour doing one thing and get it totally done, focus 100% on it, it might have taken me 3 hours otherwise, but I can focus on it and I can segment that and say, okay, that was very productive. That was very efficient. And now that one's done. Now I've got 10 more I've got to do, but that one's done. So if you segment your time, if you're working at home, into blocks of where you can work with no distractions, you can actually be more efficient. It's managing the distractions. So your employees are having to learn that. Maybe you can help them with that. But I would measure them. If you had metrics before, use the same metrics. If you didn't, now's the opportunity, like our training example, develop those metrics. And I would center it around customer retention and ranking those. I would send it on for administrative and accounting employees. I would make sure I'm getting all the right information quickly. Maybe you need a little daily dashboard or a daily report of key indicators. You know, how many invoices have come in, how many have we processed, those kinds of things. If it's that kind of a repetitive task, or maybe it's a higher level employee and you need analysis and say, look, I need you to analyze our business. I need you to analyze these customers. I need you to analyze this cost structure. And I need all this within the next week. Don't be afraid to set goals and deadlines when people are at home. Most people need the structure. Honestly, about 80% of the workforce needs structure. So don't hesitate to give them that structure, because human tendency tends to drift if we don't have goals and deadlines and structure. So you may have to give more structure to your employees because they're in a different environment. Now they're at home and there's just lots of distractions at home. So that's my advice. If you had metrics, use the same ones. If not, you're going to have to start developing. But I would develop it more around retention of customers. Maybe there's opportunity for new customers. Maybe somebody you've called on before that you know they're buying right now, but they're not buying from you. Give them a call, send them an email, get them on Facebook, whatever the appropriate method is. Try some new things. So those, maybe for a salesman, it's number of new contacts, or maybe contacts that haven't bought from you in a year if you know they're still buying. There's no use chasing customers that aren't buying right now. They're not buying from anybody. Don't chase those. Then focus on the new ones, or the ones you've tried to land. Because there's just a lot of turmoil out there right now, but people are making opportunity out of the turmoil. So the support type, or what we call the margin retention employees, are very important. One thing that I've seen some people do wrong is not enough contact. I have companies, I subscribe to a lot of services and have a lot of friends in the industries and everything. So most of the people I communicate with over communicate. I've got one that emails me 3 times a day. I've got others that email me twice a week, but I've got others that I never hear from. So they're under communicating. So you sort of have to set the drumbeat, the heartbeat of that. But I would at least stay in touch with my key employees probably every day, and all my employees once a week. You need to stay in touch with them, even if it's just a 2 or 3 line email or a text or something. And it can be generic in the sense that, it's just sort of high level stuff. Hey, how you doing? You need anything? What's going on? Some of that's okay, but try to work in a couple of specifics. Have you finished this project? Are you ready to go to the next one? Do you have time next week to talk about this one? Engage with them, ask questions. I've found, and I have to keep telling myself this, it's better to ask questions than give answers. So ask the questions, and that'll help generate, just like you guys are giving me questions. That helps me up my game. I think I had a better second quarter than first quarter this morning. I'm going to try to have an even better third quarter in our presentation. So do that. And it can be very basic metrics. So don't get hung up. Don't get hung up on it being 100% accurate. It's not like you're going to make a decision to fire them based on this metric or promote them. You're just trying to get a guide. You're just trying to keep it in the road right now. Can we live to fight another day? For some of you, some of us, that's the objective. Live to fight another day. So what do we need to do to make sure we just make it through this? Because some of these businesses and some of your businesses have probably been devastated by this. Worst thing you've ever seen in business, potentially. The airline industry never thought 95% of their customers would go away overnight, and then it would be a slow slog to come back. So I was trying to get a flight to do another Vistage presentation. I was going to do it in person up in Pennsylvania in early July. So I got on my Delta app and looked, and I can't even fly to that city. I have to fly to another city, have to fly to Philadelphia 2 days before I wanted to go. That's all that's available right now. So, that's really inconvenient. So there's just lots of things going on, but you just have to try to make the best of it, and just keep thinking, how do you innovate? How do you do something somebody else is not thinking of doing? Don't run scared. Innovate. All right. Any questions there? You want to send some more questions in? That'll be fine. Um, I've got price model up there on the screen right now. We mentioned that earlier. Pricing. When I go into clients, very often they do not have a really good price model. Their pricing either comes from a competitor or it comes from some way they've sort of always done it. Neither one of those are really effective. The market ultimately sets the price, but you get to set where you're at in the market. So we're always trying to tell customers, clients, let's come up with a formalized pricing model. Doesn't have to be real fancy, but at least it's defined. It's got our assumptions. It's got the math in it. It's sort of our out of the box pricing method. We can adjust it if we need to for certain clients. Certain clients we need to maybe price more than the model because we give more service. Certain ones we need to discount. But the first item, does your company have a defined pricing formula? And you say, well, yeah, I know it. I know it's in my head. Okay, if I walked into your business tomorrow, can you hand me or show me on the screen how you price your product or service? If you can't, that's okay. That just means you don't have a defined pricing formula. So, and defined means not only do you know it, but it's in writing, it's on a server, it's somewhere, and the people who use it every day know where it is, and they actually use it every day. It's not just a theory stuck away somewhere, it's actually used every day. So as we said, the market ultimately sets the price. You need to know your cost and your contribution margin. What extras are you giving away? I had a client that was a trucking company. They had 150 tractors and 350 trailers, and they were a pretty good regional trucking company in the Midwest. Moderately successful. Trucking is a tough business too, but they were moderately successful. Had been in business for a long time, trying to grow. And we looked at all of their clients, and we said, okay, what clients are sort of problem clients? Well, as it turned out, they said, well, we pick up every day at a certain client, and they have a bunch of destinations that we go to, but we always have to sit and wait. And we have to wait an hour and a half. We're paying the driver, we're paying fuel. It's the same old story every day. We have to be there at a certain time, but they're never ready. So we have wait time. And then when we get to the destination, they can't always take us, and we have to wait again, or we have to drop the trailer somewhere and then go pick it up again. So we're doing what we call all these extra services. So, well, let's do this. Let's change their pricing model, and let's start charging them for wait times. If it's more than 15 minutes and we had a scheduled appointment and they have a 15-minute window, then when we get past the 15-minute window or 30-minute window, then let's start charging. It's $150 an hour, or it's a partial hour, whatever our fee is, and let's charge them for that. And let's tell them up front, we're going to start charging a wait fee because it costs us money to sit and wait. If you want us to come at 4 o'clock rather than 3, fine. But if we have to come at 3 and wait till 4, we're going to charge you for that. Well, that went from being a problem customer to being a good customer, because the customer couldn't change their internal processes, but they were willing to pay us to wait. So that's not a problem. We're getting paid to be there and wait. That's as good as being able to pay and drive a load. So that turned out really well for both of us. They thought there was value in us waiting. We thought it was valuable to charge for it. Both sides were happy. We looked at another customer. We made long runs for them, 1,000-mile runs for this customer, lots of business. So, well, what's our profitability on that customer? So we measured the profitability, we measured the contribution margin, we understood what it was. And then we said, okay, what's the profitability on each route of that customer? There were 10 or 12 different routes that we ran for that customer. Well, we found out that, about half the routes were our sort of average profitability. Okay, that's fine. Some of them were premium. We made a lot of money on some of the routes. Other routes, we were losing money. I mean, we were actually shipping dollars with the route. It was below our variable cost. It was below the cost of running the truck. I mean, not only do we not cover overhead, we didn't even cover the cost of running the truck and the driver. So I said, we have to stop that immediately. We have to stop that. We can't afford to do that. So we went to the customer and said, we can't do this any longer. We've got to drop these 2 routes. They're very improper. We showed them the numbers. Say, hey, we're losing, $200 every time we pick up this load and take it for you. They said, well, we can't. We have a customer and we're locked into some pricing on this customer, and we can't pay you more because we can't get paid anymore. And we have a thin margin on it. But we will allow you to charge us that $200 on another route where it's not so tight. So we looked at it and we said, well, now for that whole customer, the profitability is going to be where we like it. We've got 2 loser routes. We've got 5 or 6 winners, and we got 2 superstar routes now. So that's good. Now, the danger of that, obviously, is they could drop the ones that were very profitable for us and make us keep the others. So we signed a deal with them and said, it's all or nothing. We have all 10 or 12, whatever it was, routes as a package. So you can't cherry pick us out of the profitable ones. So we're willing to take a couple of unprofitable because the other 2 are even more profitable, and the whole thing works for us. So that was a package price for that service, and that worked for them and it worked for us. So that was the value of having a pricing model where we understood our cost, we understood our customer, we understood the market, and we were able to develop a solution that worked for everybody. So not having a price model, we wouldn't have been able to do that. So that's the value of a price model. Having it documented, understanding your cost, understanding your customer, and if there's a problem, go to the customer. If they had said, we will not relinquish these routes, you have to keep the unprofitable ones, we're not going to let you charge more on the other ones, we would have looked at the whole customer again and said, we're making this thin margin, is it worth it? And most likely we would have said, no, it's not worth it. We're going to drop that customer because we can pick up other customers that are more profitable, even though we dealt with them for a long time. But had they not been flexible for us, we probably would have moved on. We would have taken a little time. We'd had to give them notice, all those kinds of things, but we would have moved on from it. So that's the value of the price model, helping you decide, make those decisions. That's the example of having the right metric and being able to make the right decision from it. Another question is, what extras are being given away? We talked about that. What extras need to be added for a price or sale? Sometimes you can throw in extras that don't cost you anything or very minimal, and they give great value to the customer. So that's your sales force's obligation, is to tell you, what does the customer really need? What's valuable for them? Is waiting an hour a day for them valuable? Let's price for it. Let's offer that service. We had some people in the company said, no, let's just get rid of them. Well, no, let's find a solution if we can. Turned out now they're a more profitable customer. So the owner tended to give away all those types of extras, loading or unloading. Oh, we'll do it for free. Oh, we'll wait for an hour for free. We'll do all these things. His heart was in the right place. He wanted to serve his customer, but we want to serve our customer profitably. So if there are those things that are giveaways, if waiting 30 minutes is within our realm, fine. But if we have to wait more than that, then we're going to charge for it. So understanding what the customer's real need is and being able to price where you create the value. Other trucking companies wouldn't wait. So if we're willing to wait, we need to be paid for it. And I've found in my travels, most businesses underprice the market. That most owners believe, I can never go up on my price because I'll lose all my business. And that's more fear-based than fact-based. I can't say that anytime you go up on a price that you'll never lose a customer, but I'm always for price notification. I'm not trying to sneak something in. We're saying, here's the value of the services we provide for you. Here's our current price. Here's the price we need to be at. And it's a negotiation. You try to get as close as you can to your ideal price and your ideal margin, knowing that there's a trade-off. Sometimes you trade margin for volume. Sometimes we're willing to trade that too much. Most small businesses, mid-market businesses, have more value in their product and service offering than they give themselves credit for. They tend to undercharge and undervalue what you really do and deliver. So don't be afraid to ask for a premium price for a premium service. For instance, my wife and I have some rental property, and we charge a premium for it. But everything in the houses work. If there's a problem, we immediately address it. We don't have tenant complaints. So we charge a premium, but we provide a premium service as well. So the trade-off is worth it. We know other people have properties and they don't do much to them, and they have a lot of tenant complaints and they charge a low price, but we're happier. It takes less of our time and we make more money, provide a premium service and ask a premium price for it. So you can't do that in every market every day, but it pays to seek to find those markets and those customers and those industries where price is not the primary driver. In fact, that brings us to a point. Let's look at the value triangle, the next slide in your deck. So the value triangle, and here's a good place to make another note. Draw yourself a triangle and put on the 3 points, product or service is 1 point, and that's the form, fit, and function. That's what you really deliver. The timing is another point on your 3-point triangle, and timing means the delivery, the logistics, the warranty, the follow-up, all those kinds of things. And then the 3rd point of the triangle is price. Price, I believe, is the most misunderstood decision driver because it's the most easily measured. We can measure the price, we can call for a price, we can look it up on the internet, we can get a quote, price. And so everybody believes, most people believe, that price is the number one determining factor in the marketplace. For some products and service, it is. But if price is what people buy on, that means it's 100% commodity, and commodity prices over the long term get driven down. There's always a new innovation, a new provider, a new lower cost structure, and therefore a new lower price. So I encourage all the businesses that I work with, try not to make price the bottom line. That don't try to sell everything based on price. Sell on your form, fit, and function. We have a better product. We have a better service. It meets your needs better. It's more timely. We get it to you faster. We have a better warranty. We have better customer service follow-up. Our logistics operation is better to get it where it needs to be in the right shape. All those kinds of things. At the end of the day, people want those things. And you say, well, but they also want a better price. But it's a trade-off. So if you look at your product and service offerings and you look at your triangle, say, what's more important to my customers? Is it the form, fit, and function? Are they really buying my main core business of what I do? Are they buying my timing, my delivery, the logistics? Is that the most important factor? Or is it price? And for every customer where price is the most important component, I would recommend that you start to look for customers where product and service and timing are more important. Price is always important, but you don't want it to be the most important driver. Because remember, our bottom point, price should reflect the value provided. If you don't ever have to touch the customer and all you do is pick it off the shelf and ship it to them, and that's the end of the transaction, that's just a transaction. That's just a commodity. If that's what you do or that's part of your business, okay, that's the price part of your business. But your margins, your EBITDA, your value, your multiple is going to be higher when you can base it on these other factors. Your product or service, form, fit, and function, and then the timing. Some companies are willing to pay more to get it quicker. Look at the business Amazon Prime's delivered to customers on 2-day delivery. They have wiped out almost entire retailers because of their timing is so good. And they did that through their infrastructure. If you look at Amazon, they have this huge delivery business that doesn't make a great deal of money. They make a lot more money in their cloud computing and other services that they provide, yet that's what they're known for, is the delivery. So it's a high volume, very, very low margin part of their business. They make most of their business on their Prime membership, which is whatever it is, $120 a year or whatever. They make most of their money on delivering based on just the Prime membership, not the product they're selling. It's very, very low margin, but high volume. but they make most of their money in other places because they're selling product and service, and they're selling, and of course in the delivery, they're selling timing. So try to be on those 2 points of the triangle and not as much on price. Given that some customers in some industries, it's more on price, but try to shift your business model, and you first have a pricing model, know your cost, know your contribution margin, know your market. And then second, try to move toward more selling more on product, service, and timing rather than price. So that's the value triangle. I hope you drew one out and made some notes on that, of how you go back to your business tomorrow and start thinking about these kinds of measurements and these kinds of metrics and how you move your business forward. Information is good. Actionable information is the best. So I'm hoping, one of my goals, I probably didn't say this very good at the beginning, is I want you to have 2 or 3 major takeaways today that will help you in your business starting tomorrow. And if at the end of this presentation you didn't get that, you email me and I'll call you and we'll talk. I want to make sure you've got 1 or 2 or 3 things that you can apply. That's my success story, is if you could call me in 6 months or email me or text me and say, hey, Bob, we use this. It's starting to work for us. Thank you. Man, I am on cloud 9 for that. That's what I want to do. That's what we try to do with every client. We've been very successful in helping clients do that, have takeaways, because we often go live with a client. I actually go, I'm CEO, CFO, COO at clients on an interim basis. I'll go live with them for 6 months in Nebraska or wherever, and they come away and say, wow, this really worked. This was good stuff that you helped us with. And my team, I have several team members that do a great job in their specialized areas. And that's what we want to do, is deliver value to clients. So we're really big on, we try to away from price, except Vistage. Vistage has a low price, and we get that. But we focus on product, service, and timing in our business and what we do, that we can come there and get it done quicker than anybody else, be a higher quality, be actionable, be sustainable for you over a multi-year period. That's what we're selling on our services. And that's what I try to have my clients do for their customers. All right. Come on, Vince, give me another question. You're great at questions. Okay. Let's talk about financial risk. We mentioned this earlier in your handouts, and you don't have to go to it right now, but you've got this. You've got a PDF of the presentation. You've got some handout pages that we're going to go over in the 4th quarter when we come back after break. And then you've got a few Excel sheets. We're not going to go through the detail of the Excel sheets. That's hard on Zoom. That's hard on YouTube. But you've got them there. You can review them. You can email me questions if you have any. We'll touch them just so you know what they are. This is one of them. This is an abbreviated version. But this is about financial risk. And so risk is one of those things that's hard to measure. It's somewhat subjective. And what I do with clients is try to help them make it objective. So on financial risk, and this is live off a client, we have some things here that we identified as what we thought the financial risks were. And at the end of this, and there's financial risk, there's operating risk, there's legal risk. Your expanded Excel sheet has all those on there. This slide deck only has the first one, financial risk. What we gained from this with our client was, when we came back and presented this to them and said, here's the way we read your business on risk, they said, hey, we read it very similar to you. So we were glad we had a meeting of the minds. Now we can start talking about what the data tells us and what we can do with that. But here are the financial risk we identified in this business. Yours may be similar. Some of these you can add your own. You can delete some of these, whatever. I'll run it through just so you understand how it works. So we identified price pressure, underutilized capacity. They had more plant and equipment than they had demand for. Business failure. This was a company that was losing money, so business failure was on their mind. Restricted credit. The bank had sort of seized up on them. Cash investment. How much cash do we have to put in the business? We're on the hook. There were 4 owners. They were all related, 3 brothers and a cousin. Cousin was the CEO. They said, we got personal guarantees on this business, Bob. That worries us. It keeps us up at night. Understand. I said, insufficient rate of return. If you're losing money, there is no return on your money. that's invested. You're losing money. So we said, these are the risks. Now, I'm going to use my little arrow here. You can see here, risk level. I'll sort of circle that a little bit. I don't make a good circle, but there it is. Risk level. We rated these, and you see up here at the top, I lost my arrow. Hold on. There I am. Least risk was 1. Most risk was 5. So we went down through here and rated these. I said price pressure. It was extremely competitive business. They had something I'd never seen before. I think I've seen everything. I go to a new client. I haven't seen it all. Now I've seen more. They had what's called a reverse bid process. Now let's talk about what reverse bid is. You know what a bid process is. You're bidding to buy. You're increasing your price because you want to buy something on the internet, or you go to a live auction or whatever. I'm a car guy, so Mecum is my thing. I want to go to Mecum. I've been studying Mecum. I'm going to go buy a Mopar muscle car. I think the prices keep going up. I'll have to bid. I'll bid against other bidders. There'll be bidders in the hall. There'll be bidders on the internet. There'll be bidders on the phone. I have to bid against all these people to get what I want. So I'm bidding the price up. A reverse bid is the opposite. You bid the price down. They had to participate with their competitors. They had to go online to the customer's website on a specific day at a specific time with specific SKU numbers, and we're going to keep bidding the price down. So we're going to sell this to you for $1. Competitor comes in, we'll sell it to you for 95 cents. Next competitor says we'll sell it to you for 90 cents. It was a disaster. I'd never seen anything like it before in my life. I was nearly in tears over it. The price just kept coming down. So we had to help them establish what's the bottom price you can sell this for and still make some profit, and what's our acceptable profit on it. So they had extreme levels of price pressure. We rated it the highest risk there was, 5. We rated these others as 4. Cash investment was 1. They'd put no money in the business in years. Even though they were losing money some years, they'd make money some years, they still didn't have to put cash in the business. So that was good for them. They had personal guarantees. That kept them up at night. We rated that a 4. Insufficient rate of return, I rated that as a 5. That's a very high risk level because it wasn't very profitable. All right, I keep losing my arrow. Okay, weight. We had to weight these 1 to 5. Now, this is the subjective part that we're trying to turn this objective. So I weighted price pressure as a 1. I rated business failure as a 5. That was the most risky weight we could have. If we fail and go out of business, that's an extreme risk. Some of them restricted credit, I rated a 3. Sometimes there's ways around that. Personal guarantees, I weighted that as a 3, about average. Then you just multiply these. So you just multiply the risk level of 5 in the first one times 1 is 5. Then you just add all these up. That gave us a 65. Now we had 3 options up here for this company. So we had option 1, 2, and 3. We're not going to go into that detail, but these were some options we gave them. They could do some tweaking and tuning, as we call it, lean process engineering, some things to improve their business. They could do a total business makeover, or they could sell out and convert it to cash. So all these had different risk factors, different risk levels. You may just have one. You may just say, hey, I'm just trying to improve my business. I don't have other options. I'm just trying to improve. But my challenge to you is you can go back to the office tomorrow. You can take our spreadsheet. You can list your risks. You can put a risk level, a weight. If you want to call me and let me help you with that, be glad to talk you through it. And you come up with a mathematical score. And then you add up your scores. And if you have more than one option, and you always have more than one, but you might only identify 2. You might identify 3. Tweaking and tuning, major improvements, selling out. You could use these 3 options. All this does is help you quantify the risk in a way that you haven't done it before. It's been in your mind. Now we're putting it on paper, on Excel. And it helps you rank the risk factors. So it helps you quantify something that is normally pretty subjective. Now, is this 100% accurate? Yours is not better than mine. Mine's not better than yours. It's trying to give you a ranking. So if you see in this option, the current state, where they're at today, was rated a 65. If they improve their process, they reduce their risk. They've improved their processes. They've made a little bit more money. They've reduced their risk. Total business makeover was actually less risky because the market was changing so fast. We recommended they do a total business makeover, establish an international presence, move from your current facility, lower your cost structure, lots of big ideas. Or then one brother wanted to say, let's just sell out. Let's just convert it to cash. You can see that's the least risky one. We're not in business anymore. We've sold it. We've converted it to cash. Maybe we got more than we wanted. Maybe we got less than we wanted, but we're out of it. Our risk is gone. We can put our money in FDIC banks, or we can invest in the stock market. We can do whatever we want to. That'll have a different risk profile. But as far as this business, that was our least risky investment. So we did rank that they had a business failure risk until they were converted to cash. That was still a risk. Every day they were in business was a risk because they were losing money. So that just helped them rank and quantify. They could see on one sheet of paper, okay, here are my financial risks in business, in this business, with my current state, my three different options. Now, what they chose to do, I'll just give you a little insight. We recommended makeover number 2. Now, granted, you haven't seen yet the operational risk and the legal risk. We're just not going to go through that right now for brevity. But this total business makeover at the end of the day was the least risky of the 3 options for them. But they chose the more moderate, had a higher risk, but they felt better about it, this structured process improvement. They didn't want to sell their building. They didn't want to go to another building. They didn't want to downsize. They didn't want to reinvent the business. They didn't want to go international. But they said, let's just tweak and tune today and make better processes that we're doing. This is the same company you saw at the beginning of the presentation where they had made all those cash improvements and earnings improvements off what we first started with this morning. So it worked for them. It wasn't the option we recommended, but they hired us to implement this option. And we did that for them, helped them. They worked very hard at it. We just guided them through it. 2 of us there worked on this full time for about 6 months, maybe 9 months. And they got to where they wanted to be, what they were comfortable with, the risk they were comfortable with, and it's now a profitable business and has been for several years. So that was a big win for them. But part of the key was helping them understand what their risk was. So my challenge to you is to take this Excel sheet that'll be in your pack and put your own risks in there. Think about the ones we've got. Try to start ranking them by weight and risk level, and just see what you come out with. And if you have questions, call me. But I think that's a valuable exercise to go do. It simply takes risk out of your mind and documents it. Now you have something to share with your family or your team and say, okay, here's the way I see the risk. Give it to them. Let them do it too. And see what they come up with. And maybe you all agree to agree or agree to disagree. That's okay too. This is an opening to talk about risk. Is this a perfect model? No. Does it document some of the main factors and help you start the discussion? Yes. And that's what it's designed to do. Because most people have no idea other than conceptually what the risks are in their business. We encourage people, let's manage by data. So let's identify what we think the risks are. Let's put a weighting to it. Let's put a ranking to it. Let's see how it compares. Now we got something to talk about. All right, so I've talked a lot here lately. Vince, help me out. Come up with some more questions. Any of you, we're glad to try to answer those. And as we said, I know a lot of you are hurt by this COVID-19. And we can't talk specifically about details in your business right now. We don't have the format for that. But certainly in general, you want to keep measuring the things you're measuring, or some of the things we've talked about today. Let's start measuring those, measuring employees at home, measuring, even if you're not worried about your EBITDA today because you're losing money, understanding your contribution margin is pretty important. And I encourage you to calculate that and your true profitability by business segment. I'm glad to help you with that. Your accountant, your controller, your CFO, your outside CPA can also help you with that. They may not be as familiar with some of those concepts, but they'll understand it in general. They'll certainly understand how to help you dissect your balance sheet and income statement to come up with the answers. If you take these questions to them, they can help you get those answers. They'll at least know where to dig, and they'll understand the concepts anyway. All right, a few more minutes here and we'll take another break. We'll take our last break. let's talk about this for a minute. This will be a good lead in. I've got a few slides here. I oftentimes Vistage groups. I didn't do it with this group. I've not been doing it this year. I was doing it last. I did. I have about 100 surveys that I've compiled, and I said, what confidence level needs to improve in what areas? And the number one item, I have it in red there, was understanding our profitability by product, service, and customer. That's the number one thing that most small and mid-sized businesses don't understand. Where does our profit come from? They know it in all. Most business owners can tell you, hey, I made $800,000 last year. I made $2.2 million last year. Which customers? Which product? Which service? Not in general. What did we make on those? You have it in your mind conceptually. You sort of have a gut instinct as, okay, I'm making on this customer. But when you get down into the detail, you'll find out, oh, well, I forgot we did that for them. Just like my trucking company owner. Well, I forgot that we sat there an hour every day. And I forgot that we did this. I forgot that we threw that in. So this helps you quantify that. So I'm really big on, make another check mark here, understanding profitability by product, service, and customer. See the next one. Here we are. Let's see, make sure sorry, got excited here. All right. Here's another, trends that need improvement. Revenue and profit growth, not confident for the coming year. That may not be your biggest concern right now. Survivability may be your biggest concern. So if that's your biggest, let's talk about this one first. If you have a plan, and I've got some clients that are going to stay on plan this year. They're fortunate they're in industries that are going to be okay, and they're going to stay on plan this year. They may be off a quarter. They may make it back up the next quarter. So I'm not so concerned about them. But if you're in survival mode, then you need to understand what your fixed costs are. You need to understand your contribution margin, and you need to start planning for what if I don't come back from this, my customers don't come back from this quickly enough. What are the levers, the action items that I can do? So can I get out of the real estate? Can I postpone it? If you're not already negotiating, you need to negotiate from a basis of fact. So you need to have your financials, you need to understand them, you need to be able to explain them, and go to the landlord, go to your biggest suppliers, go to your biggest customers, the most significant ones, and start to negotiate to say, what can we do from a timing standpoint? And that's a better argument to have. Many companies, thousands, are going through these negotiations right now. You have to negotiate with your bank. I've got one client who's concerned about busting their covenants. I said, look, you and 99% of the other folks are concerned about busting your covenants. The banks are going to have to be flexible in their covenants this year because most companies are going to bust their covenants. But if you have a plan of when you're going to be back in covenant, that gives your bank more confidence. The bank understands your business conceptually. What they don't understand are all the specifics and all the day-to-day that you do. So you have to convince them that not only do you understand it, but you're in control of it. You have a plan. You know what your results are now. You know when you think you know when you're going to come back, what that looks like, what changes you're making, positive and negative changes, and what you think it's going to look like. If you can outline that for your bank and have a go-forward plan, you're already ahead of 90% of the people. They'll appreciate that. At least you have a plan. At least you're working on it. They can argue about the detail. You can take their arguments into consideration, but having a plan that you can present is a lot better than not having a plan. So I encourage you to do that. We talked a little bit more about this, and we're going to talk a little about more in the fourth quarter when we come back from break here in just a minute. Financial function, CFO, advisor software, value add versus compliance. We're going to have a little exercise or two in the fourth quarter, make this more exciting. I think you'll appreciate it and give you some insights on what to expect from controllers versus CFOs. Some of you may have one, some of you may have both, some of you may have neither, and that's okay. You're at different cycles in the business. But what's the difference between a controller and a CFO?
Question from Kathy.
Okay, so Kathy's got something. In your opinion, what industries are ripe for acquisition? Those are industries, and it's hard to know specific industries, but trends in industries. I have a customer in the ag farm equipment industry, and they're doing dealer roll-ups. So that's an area, and you've seen that in the automotive industry. Many dealers are rolling up to become super dealers, mega dealers, because retail dealerships, are having a hard time surviving um, without multiple brands, multiple locations, multiple stores, because the fixed costs are so high they can't spread it over. They need to spread their fixed costs over a wider assortment of brands, products, services, and locations. And they can hire one CFO as opposed to five. And so you spread costs like that. So dealerships are something that's going to roll up. Smaller providers, IT services are rolling up. Um, so I think where economies of scale make sense in businesses, I've seen it in fire suppression. I had a client, they're doing roll ups in that industry. A lot of dealers or service type organizations are rolling up. They're being acquired. Some manufacturers are being acquired where they can be put together with other like manufacturers. If they're all in the metals business some way, PE firms will roll up a bunch of different metals type manufacturers. So where similarities and where economies of scale make those are the kinds of roll ups. Higher margin companies are ripe for acquisition because people are looking at where can they make money. COVID may be with us a long time, but the impact of selling more toilet paper, I think that has a short lifespan. People get back to normal on that kind of stuff. We may have another wave of this, so you may have another surge, but I wouldn't go out and buy toilet paper manufacturers um, because I think some of that's temporary. Service businesses that have high margins are ripe for acquisition. Manufacturers that are similar in nature are ripe for acquisition. So many businesses are passing from the baby boom generation to the next generations. Those are ripe for acquisition, particularly those whose the kids didn't grow up in the business or they don't like the business. Many of those businesses are going to be sold over the next 10 years. We're already seeing that trend. And some of them, the best ones, are going to sell for high multiples. So that's that's what I would look for if you're looking to acquire or wanting to be acquired. Um, Good companies will. It's interesting. You would normally think that a buyer wants to pay the least amount of money that they can for a company. That's generally not true. Buyers want to pay more for a company when there's value. So if you're the most valuable or second or third most valuable in your industry, in your geographic area, they will pay a premium. I was involved several years ago. It was at a market peak, granted, but we sold a small manufacturer for 9.5 times EBITDA when the market was at 5 to 7, because they were number one in their geographic area. They had an A customer list. They had expandable facilities. They were able to not only manufacture but distribute as well. So it was right for an acquisition, and the acquirer said, we will pay a premium because you have all these things in place. You're not just the next average manufacturer. You've got some real juice going for you. So again, they got a 9.5 times EBITDA when the average was 5 to 7 because they had those other things in place. And that was a lot more valuable than making 10% more EBITDA because they changed the multiple. So those are some industries. Let's stop right there. It's at the half hour. Let's make this a 15-minute break. Let's come back at a quarter till for the fourth and final quarter. We'll spend a good 45 minutes. We'll get through the rest of our subjects. I'll let you guys then go for lunch and the rest of your afternoon. And looking forward to it, but have a good 15 minutes, and we'll see you back here. Thank you.
You are back.
All right, we're back from break. Time for the fourth quarter. We're going to have a strong finish. We got to get another score to win. So that's our objective. Now, I'm getting ready to make a pivot. Had a couple of questions come in, so we're going to answer those. But our pivot's going to be, you can do this one of two ways. We have on the screen the next thing we're going to do. It's not on the PowerPoint slide. This is in your PDF pack. So you go along on the screen, that's fine. Or you want to open the pack with a device or do that, you can do that as well. We're going to have an exercise. You're going to have a couple things that you're going to read. You're going to have one where you're going to answer some questions. So whichever is easier for you is fine with me. So if you want to open the PDF deck, that's fine. Or if you just want to watch it, everything that you're going to do is going to be on the screen anyway, whichever you're more comfortable with. But before we do that, if you're going to open it, you can go ahead and open it now. But before we do that, we're going to answer a couple of questions. So Vince has had a question. He says, I found it difficult to have a defined pricing model because of the difficulty of assigning manufacturing overhead at variable levels of volume. The more volume, the less overhead, the less volume, more. Do I average overhead or apply an ideal amount based on sales targets? Okay, great question, and gets to some of the things we touched on earlier. So Vince, and I spent a lot of time in manufacturing in my career, and I love manufacturing. And this is a very common issue, is how do I assign overhead, particularly in a changing volume, maybe a dramatically changing volume environment? So great question. So here's my answer to that is, if you'll go back after the presentation and you look more at those definitions of contribution margin, you really need to look at your direct cost. So if you're going to sell a project, you're going to sell an order, you're going to sell a job, how much material, how much outsource, how much labor, those are your direct costs that are involved. You may put a little bit of indirect on there because you may have inspection time, or you may have some QC time that's outside the normal process of QC that you go through. But all the direct costs that you associate, that's fine. But then all of the fixed cost of manufacturing overhead, like depreciation, utilities, rent, those sorts of things, supervisor salaries, I would not include that in your calculation. You want to look at your contribution margin purely because those are fixed. Look at your contribution margin without those. The caution is, go back to your plan, go back to your budget and say, what percent of revenue are those fixed costs? Let's say they're 15% of that on average. You're going to have to ride these ups and downs anyway. You can't change your pricing easily just because your volume's lower or higher. But knowing that knowledge, let's say your contribution margin is 60% and your fixed overhead component based on your plan numbers is 15%. So 60 less 15 would be 45, would be your net margin, your gross margin on that. But the 65 or the 60 is more important because that's your contribution margin. Your pricing has got to be based on that. That doesn't mean you take it all the way out and take all your margin out of it, but you can't really change your pricing based on these kinds of big volume swings. So you need to know what your fixed costs are, but you can't let that completely influence your pricing decision. So your pricing model for the year needs to be based on that. You know what all those costs are. You know your pricing, you know you're getting a bottom line margin. But as your volume changes dramatically, you can't change your pricing dramatically. So the short answer then is, if your volume's going down, depending on the market, you might be able to bump your price up a little bit, maybe 5 or 10 percentage points, to make up for some of the fixed costs that you're not covering because your volume is low. Or depending on the market sensitivity and the price, you might have to cut your price 5 or 10% percent and pick up more volume that then offsets that that lack of coverage of fixed cost. So it depends on your market, but you can't just assign the overhead and say, okay, my volume's in half, my costs are now twice as much per unit, therefore I have to double my price. You just can't do that. The market just won't allow that. So don't try to chase that. Just know what the numbers are and try to make adjustments on the margin for your pricing up or down to either pick up more volume or to pick up more margin as you can. But don't try to just assign, like I said, and say, because my volume is down, now my cost per unit is doubled because I don't cover it. You'll just chase it forever and never get there. Because at the end of the day, the market's going to set the price. The market doesn't care that your volume's down, but you can make adjustments on the edge to try to minimize the impact. That's really what you can do. And I've seen people chase the fixed cost percentages all over the map and price themselves out of a market because they didn't have enough volume. You've got a volume range, between, I'm just making up some numbers, between 1 million and 2 million, you can make money and cover all your fixed costs. At 2 million, you make a lot of money. At 1 million, you're break even on this product. So when you go down to 500,000, there's no way you're going to make money. But if you can minimize that and go up on your price, and now instead of charging 500,000, you're charging 600,000, you've made up 100,000 of it, and that's better than losing 500. You only lost 400. It helps you live to fight another day. So that's the answer. And if we need to talk offline about that in more detail, I'll be glad to do that. But that was a great question, and one that manufacturers always chase, especially in high volume swings like we're in now. If the volume went way up, you're printing money. It goes way down, you're losing a ton. You can only adjust within a relevant range. So I hope that answered your question. If not, I'll be glad to pursue it some more with you. But thank you for that. Okay, now we make the pivot. What we have before you now on the screen is a force rank template. And this is just a tool to help you rank your employees. The objective of this is to show you differences in how you view employees. So what I'm going to ask you to do is to take your employees, take one employee, preferably a direct report that you have, and think who it is. If you need to jot their name down on a piece of paper, that's fine. And there's 10 questions on here, and I want you to answer those 10 questions about this employee. And the instructions say to answer with your initial reaction. So this is not a long time thing. This is a 2 or 3 minute exercise. Use a scale of 5 as the highest. So if you answer the first question and say, yeah, they're the best in the business at this, that's a 5. If they're not good at all at this particular point, give it a 1. So I want you to read these 10 questions. I'll do a slow scroll on the screen so that you can see them all. One employee, one of your direct reports. Let's see how many questions we can get up there. I don't exactly have this size to fit the screen, but rank 1 to 5, 5 being the highest. So I've got almost 1, 2, 3, 4, 5, 6, 7, 8. Got 9 of them up there, so I don't have to scroll one more. First question: how well does the manager perform the routine responsibilities? 5 being the highest, 1 being the lowest. I'm going to be quiet for a couple of minutes. You go through, write down somewhere your score on each of those, and then we'll continue the exercise. I'll give you a couple of minutes. Oh, Kathy has asked, will we have access to review this video after we are done? Yes. This video will be published on my website. You'll have access to it all through this coming weekend, so another 5 or 6 days. It's yours. It's part of the fee that you're paying to Vistage. It's proprietary in the sense that it's for you. And if you want to copy it down to your hard drive, that's fine. After the presentation, after the weekend, if you still need it but you didn't copy it, email me. I'll send you a link, and you can go directly to our website and download the whole thing. It won't be publicly available on our website, but I'll give you a link so you can get to it. So I'll pause for a couple of minutes. Okay, if you haven't finished, go ahead and try to finish up the last 2 or 3 questions. When you get complete, add up your scores. Add up your scores. Okay. Now, you've got those added up. Before you do anything else, write down. I sort of messed up my own exercise. I got excited here in the moment, but put your impression of that employee, just your overall impression of that employee, 1 to 5 on how they do their full job. Whatever comes to mind quickly, you can make it to 1 decimal place if you like. Give them a 4, 4.5, 5, 2, 1, 3.2. Put that down somewhere. I really needed to have you do that at the very beginning of this. So I lost a little bit. My fault, not yours. You followed instructions. I didn't follow my own instructions. So you've got that number written down somewhere. You've got an answer to all these questions. Now just add up what you put down. Just add those up. This is the only math on the whole morning. So just add those up quickly and divide by 10. And if you're challenged, just move your decimal point to the left after you had added up. Move it 1 space to the left. So you should have a score somewhere between your average, after you've added them up, divided by 10, should be somewhere between 1 and 5. Maybe it's 4.5, maybe it's 3.5, something like that. And then you should now look at the score I had you write down earlier, your overall, your initial impression, without answering any questions. You've got a score there. So the score you wrote down, your overall impression, if that's higher than the average score after you added them up and divided by 10, that means your subjective impression was higher than your objective measurement. Your subjective was higher than your objective. If it's the other way, if your scores and divided is higher, then that means your objective was higher than your subjective. In other words, your general impression was less than when you actually answered questions. And normally when I do this little exercise, I normally started off a little better than I did. I apologize. But we see about half the group one way and about half the group the other way. So what does that tell us? This is very, quick and simple, but it tells us that our overall impression of someone is different than when we sit down and think about it and answer specific questions. And that's just because we all have some degree of bias and subjectivity and different things that roll into it. It also says that what I think of an employee as a really strong employee or a really weak employee, I may miss the mark. I may have the wrong impression. Someone who's closer to them may have a better impression. So the challenge here is, if you go back, if you're really bold, give this to your team and let them rank you. If you're not quite that bold, and that's okay, you can rank all of your team members, subjective and objective, see if there are significant differences. If they're close, probably everything's good. But you can also pick other people in your organization. For instance, if you have a CFO, pick your CFO. I've been a CFO a number of times. I like to pick on them. I got picked on a lot. It's okay. It's part of the deal. But you could ask your other senior team members to rank the CFO. Do this little exercise on the CFO. Turnabout's fair play. Ask them to do it on your VP of operations or your VP of marketing or your VP of engineering or whoever your senior team members are. So do that on sort of each other and see if there are significant differences. You may be wrong. You may be right. It's a conversation starter. If you don't do evaluations, I encourage you to do that. There's a number of companies that can help with that. There's a number of organizations that have that. There's a number of things on the internet about that. But we need to understand who our best players are. We need to, and we're all human. We all have strengths and weaknesses. I have more weaknesses than strengths. I just try to play to the 2 or 3 that I have. But we all are part of the team, and we all have to be measured, and we all have to try to constantly improve, myself included. I get critiques from my team members, and I ask for them. I ask them to do that. Now, they're pretty merciful in how they do that. I don't know if that's because they're afraid I won't sign the next check or whatever. But anyway, they're very good about saying, hey, Bob, could you do this a little different? Could you do this differently? I've had one of my team members here this morning helping me. And he says, hey, you really need to do this a little different. Well, he's right. So I'm trying to do some things different to improve, sort of on the fly here. But he's had some good comments and good critiques, and I appreciate that. So again, it's a conversation starter. It's a very elementary tool, but if you don't have anything, it's a starting point. And it's usually an eye opener in these Vistage presentations, because Vistage, and I'm a big Vistage supporter and fan, it's all about improvement. It's all about helping our companies, our families, our communities, our businesses, our employees get better. And so this is just a little tool that you can use. It's in your package, and feel free to use it to try to help you in your business. Anybody have any questions about it? Very simple, very elementary. If you give it to an HR professional, they'll probably laugh at it, but that's okay. You can tell them you got them from a crazy guy at Vistage, so it's okay. That won't bother me. I'm a crazy guy at Vistage. Okay. If you do have a question, there's a 15 or 20-second delay. As I'm going to skip this decision making, which I actually think is another good tool, but I want to concentrate on something else right now. If you have any questions before we start this next section, feel free to top chat them right in. Okay, this next section, again, if you've pulled it up from the PDF, that's fine. I'll sort of slow scroll on the screen if you want to look at it that way. This is just a little write-up that I did for a Vistage client on what's the real difference between a CFO and controller. So I think this is valuable. If you'll just take 2 or 3 minutes and read this, there's no math, there's no exercise on it. Let me just advance it a little bit. Go ahead and start reading, and I'll try to slow scroll it. Just read through that. We're going to talk about that for a few minutes. All right, if you're not finished, go ahead and try to finish that up. Malcolm, just for your information, I'm going to finish on time at 11:30. Um, if you want to send me a chat of something you want me to say to the group before they're dismissed, because I know you've got a lunch break and you're going to come back on a Zoom setting. So if there's anything that you want me to say to the group, just let me know, and I'll be glad to announce that. Um, and we'll be winding up in 20 more minutes. So this is CFO versus controller. As I said earlier, some of you may have a CFO, you may have a controller, you may have both, you may have neither. But I've always found this interesting when I talk to Vistage groups, as some people don't understand the difference. And I think this is just a summary of what the key differences are. Both positions are important. Depending on where you're at in the growth curve, you may not be able to afford either one right now. You may be in a part of your business where you have a bookkeeper, or you have an accountant, or you may have a lot of that outsourced. Nothing wrong with any of that. My encouragement would be always be looking ahead. What's the next move? What's the next thing you have to do? If you're looking to grow your company profitably, you ultimately have to have a CFO. Now, that doesn't mean you have to go out and pay $150,000 a year today for a CFO. But what that means is that as you grow, you need services of bookkeeper, accountant, controller, CFO. Many of those services can be purchased. They can be outsourced to very qualified candidates. There are people who do that individually. There are people who work through different companies. B2B CFO is one. There are a number of them out there that are good. CPA firms can recommend people to you. But if you can't afford a full-time CFO or controller, buy one on a part-time basis. Outsource that service to them, because you need, in order to get to the next level, you have to have people who have been at that level, understand it, and help you get there. So that's my encouragement. Know the difference. You need both sets of services, and always be looking ahead. And if you want to get to the next level, you may have to be bringing that service in at your existing level to help you get to the next level. You usually can't get there without it. So whatever level you're at, be willing to have access to the right people at the level you're at to help you get quicker to the level you need to go. I've been in a lot of companies because I have a financial background. It's an area that they've neglected. They can't figure out why they're not profitable. They don't understand a lot of things. Had they brought in the right people earlier, they would have gotten beyond that earlier. So it's really cost them time and money and energy and effort and lack of profitability because they didn't have the right team members. I completely understand you have to be able to afford something. But there are ways to buy expertise services that you don't have to make a full-time commitment for. A lot of times a CFO can work a week a month, and that's great. And that's maybe all you need at the time, but they can help guide that ship and guide you. Your CFO should be probably your number one business advisor in your company, even if they're outsourced. Okay. All right, so that sort of winds up that part. What I wanted to say about that, in your pack, if you want to go, if you're following along in the pack, it's the slide right before. It's like 2 or 3 slides right before. This is a decision-making model, and I'm not going to go through this in detail, but I want to call your attention to it. There it is on the screen: Management Decision-Making Model Framework. Again, we developed this for a Vistage client. They said, we need a framework of how to make decisions. So we designed this for them, and it's generic enough that it can apply to most businesses. Executive level and strategic decisions, and we're just going to touch these topics. You can read them in more detail. You can email me questions after the presentation, or if you have a quick one during it, we'll be glad to address it in the next 15 minutes. Does the decision support our mission, vision, and values? Most companies have mission, vision, values. So at the strategic level, any major decision we're going to make at the strategic level, does it support our mission, vision, values? That's a basic question. Is it keeping us on course? Is it taking us off course? Very basic question. Does it reflect our customer-facing attitude? This client was very big on customer-facing, as most businesses should be. Everything we do, we want to make sure we're facing the customer correctly and that everything we're doing enhances our customer relationship. So does it reflect our attitude of customer facing? And does the decision benefit our owners? That's not necessarily all profitability, but the owners want to grow the company generally. They want to have profitability. They want to hire and retain the right employees. All those goals. Does it really help our ownership goals? You may be the sole owner, you may be one of many owners, but at the strategic level, executive level decisions, does it support our mission, vision, values? Is it customer facing? And does it benefit our owners? All right, then we go to what we call operational level: planning, responsibility, and accountability. One of my other partners, who's also named Bob, we have more than one Bob in the firm, makes it really confusing. We call it the 3 C's: capability, capacity, and commitment. Do we have the capability to perform properly whatever we're committing to? Do we have the right skills? Do we have the right staff? Can we hire that out? What do we do? Do we have the capability? Do we have the capacity? Is it short-term or long-term? Do we need outside resources? Don't be afraid to bring in outside resources to help you. It's sometimes very cost-effective in the long run to bring in expertise help in the short run. So do we have the capacity to achieve the results? And do we have the commitment to execute? I've been in many companies. We've been on long projects, and they get fatigued. They run out of effort. They run out of time. They run out of energy. So are we going to devote the time, effort, and energy to execute what we've committed to? Do we have the internal fortitude? Do we have the commitment to carry through on what we're trying to do? IT projects are a great example. We're going to put in a new ERP system. Everybody's excited. 6 months into it, everybody's depressed, and we still got a year to go. So we didn't have the commitment. Many long projects fail because of lack of commitment. People just run out of gas. They run out of energy. So do we have the commitment to make sure that we execute properly? And then at the employee level, the people that are making it happen, the nuts and bolts. Have we given them the right plan to execute? Does it have objectives? Does it have timelines? Are we monitoring the results? Are we flexible to adapt? Is it clearly communicated? Do we have the right plan? Many companies fail because they never had the right plan in place. Do we have the right metrics? Of course, I'm a metric guy. I obviously think that's very important. Do we have the right data? Are we measuring the right things? Are we looking at true profitability? Are we looking at contribution margin? Are we looking at net working capital? Are we looking at EBITDA? Are we looking at value added per employee? Are we looking at those key things? Are we measuring it correctly? And will we reward the right behaviors and the right results? We want our sales force to go sell a new product. We have to incentivize them to do that. We have to communicate the importance. We have to show people why it's the right strategy, how it fits the strategy. Remember, most companies that innovate, most companies that move forward, there's never 100% agreement up front. We have to bring people along. We have to do a lot of hand-holding, a lot of convincing, a lot of persuading, a lot of selling, even to our own staff and our own employees. But we have to be flexible. We have to take the feedback. But we want to incentivize people to do the right behaviors and the right results. Even sometimes it's going to cost us money in the short run. I've had clients that are in the service industries, and they go out and somebody put in something wrong, and it's going to cost us money to fix it. But the right thing to do for that customer is, we made a commitment up front. We haven't lived all the way up to it yet. Now we're going to fix it. We're going to stand up and be big boys about it. And we're going to fix it right, and they're going to leave. When we leave, they're going to be satisfied. So we reward people for doing the right things, not for cutting corners, not for cheating, not for doing the wrong things. We're rewarding people for long-term results. I know many companies that they've worked on their culture for many, many years to make sure they have the right employees and the right culture and the right commitment, and it pays big dividends in the long run. Costs money in the short run to develop it all, pays big dividends in the long run. So let's reward the right behaviors to get the right results. So that's what I'm going to talk about there. I'm going to take another pivot now. You have some other information on here. I'll just call your attention to it. There are some cash flow bullets. So if you're looking to raise cash, increase your cash flow, we've got a number of things you can read through there. You can email me later if you want to talk about them. But those are some things we found over the years that work to help companies with cash flow in all the major areas. But I'm going to pivot back now to the PowerPoint deck and call your attention to the last couple of slides as we start to wind up here. You can just scan those cash flow bullets while we pivot.
I got you.
Okay, there we go. All right, so leadership. This is the next to the last page in the PowerPoint deck. It's the most important factor. That's the value you bring as the CEO, the owner, the president. You are the top leader in the company. Just like I'm the top leader in my little company, I have to bring these values every day. Having the right principles, integrity, honesty, values, they never go out of style. But people laugh at it. They think it's contrite. They think it's old-fashioned. These are the things that sustain companies over the long run, sustain families, sustain individuals, sustain employees, sustain communities. Have the right principles, integrity, honesty, and values. As a CEO and the owner, you alone are responsible for the culture of that company, the commitment, and any changes that are brought to it. You have to have other people help you. You have to have other people implement. You have to have other people give you ideas. But you are responsible. The buck stops with you. You're responsible for the culture of that company, its commitment, and its changes. And we have to go through changes every day. You're responsible. I believe if you establish the right priorities, focus on the most important factors, you will deliver the best solutions. The right priorities: treating your employees right, treating your customers right, treating your vendors right. Focus on the important factors that help you grow your business profitably, serve your community, serve your customers, deliver solutions for them. That's what makes that business valuable in the long run. That's what makes it all worthwhile. So that's what we try to do in our business. That's what we try to tell Vistage members to do. Vistage has great attributes. it's much of what we talk about are the same things they talk about, what you talk about, I'm sure, every month, what Malcolm guides you to do. But remember the leadership responsibility. Even though there are many leaders in your company, you are responsible at the end of the day. So we're probably gonna wind up here just about 5 minutes early. So that's the presentation. Let me remind you of my offer. Here's our contact information. You can half a day of consulting at no fee. Be glad to do that. Be glad to answer any questions by email after the presentation. If you've got any here right before we leave, I'll be glad to answer those. Again, Malcolm, let me thank you for inviting me. I certainly appreciate the opportunity. I appreciate each one of you who have participated today. You've had great questions. That's helped me a great deal. I apologize. I sort of had a little rough start there in the first quarter. We got through some of that. Your questions helped me a great deal. I appreciate your patience on doing this by YouTube video. I know that's a little different than Zoom. I think it's been a better experience, but if you want to confirm that or tell me that's not true, I'll accept that, and because we're always trying to get better. It looks like we'll be doing something like this for the next several Vistage meetings. So anyway, thank you very much. I have a message from Malcolm. And he's thanking me for the virtual session. You're quite welcome. I appreciate that. Appreciate you allowing us to do it this way. So again, contact us if you need anything. We're glad to help. Thank you for the opportunity today. Have a great break for lunch. Come back at your appointed time. I think Malcolm, maybe 1 p.m. I think it is.
Yeah, he posted it for me.
Okay, good. 1 p.m. Central Time. You all come back. Have a great session this afternoon. Thank you again very much. Thank you.